the U.S. is going to continue to attract capital.
When you think about the U.S. economy, it's in a good place.
There is reason for optimism. There are green shoots that people are able to point to.
The ability to be successful, the rules, all that has really driven strong growth in the United States.
As America goes, so goes the world.
This is Bloomberg Surveillance, live from Davos, with Jonathan Farrow and Lisa Abramowitz.
Good morning, New York. Good afternoon, Switzerland. Good evening, Tokyo. This is the final and fourth day of the World Economic Forum meetings. And today is a day that huge gap we've been talking about between Washington, D.C. and Davos will close. President Trump has been looming over every conversation here today. He will speak directly to the group and take questions from Anna Botin of Santander, Brian Moynihan of Bank of America, Blackstone, Stephen Schwartzman, and Total Energies' Patrick Pouyanné. I'm alone right now. And it's not because John drank too much last night or decided to go skiing or decided just to look at the snow. He's hosting a panel and will be joining us later this hour. We also will be speaking to two of the great guests on his panel, Katie Koch of TCW, as well as Bill Ford of General Atlantic. In the meantime, you're stuck with me. U.S. and European stock markets hovering near all-time highs, with the S&P posting the best start to a year so far since before the pandemic. You are seeing markets pull back just a touch, but this is really off the record close that we saw yesterday on the S&P 500. Focus on big tech. Can they continue to lead in the yield space? Still some knowledge, although a little tick higher. Right now, all eyes turn toward where AMH is in Washington, D.C., where President Trump has been taking questions. Anne-Marie, what have we learned from an interview last night with Fox News and President Trump? And what do we expect to learn today in his discussion with Davos attendees?
Well, I think what we're really seeing, what we learned last night from his sit-down with Sean Hannity, is that we have a change of heart from this president as he takes on this second term, especially when it comes to the likes of TikTok. Of course, remember, in his first administration, he signed an executive order demanding that ByteDance divest from TikTok. This was based off national security concerns. Now what we've seen from this president is he's signaling that basically anything that comes out of China that's an electronic device could potentially be a spying device. Take a listen.
We have our telephones made in China for the most part. We have so many things made in China, so why don't they mention that? You know,
Let me get to
the
some
interesting
issues.
thing with TikTok, though, is you're dealing with a lot of young people. So
they love it.
Is it that important for China to be spying on young people, on young kids watching crazy videos and things?
Lisa, in a world where literally everything is basically transmitting some sort of digital information, Trump is basically reviving this debate about what is considered national security. And this potentially may cause a bigger debate within his own administration, given the fact that you have the likes of National Security Advisor Mike Waltz, the new Secretary of State Marco Rubio. They have been very critical about TikTok, and they are definitely considered China hawks. And potentially we will get questions regarding national security, China, especially trade with China today, when Donald Trump will be zooming in as the 47th president of the United States into Davos, and he's going to be taking a lot of questions. Now, I've learned that this Zoom is supposed to last 45 minutes. Based off what we've seen of just the first few days of his presidency, he'll likely take more questions and it'll last more than 45 minutes. But you could see who he's going to be speaking to there. Steve Schwartzman, not only, of course, of Blackstone, but someone who has supported the president. And maybe we'll get some energy questions from Patrick Pouyanné of Total.
Anne-Marie, thank you so much. And surely that is the discussion here, how to understand what national security is, how to correctly regulate technology at a time where people are talking about the potential influence of artificial intelligence. We turn now to someone who is brave enough to make the commute directly from the inauguration festivities in Washington, D.C. to the alpine vistas of Davos, Switzerland. Arkansas Governor Sarah Huckabee Sanders joining us now here in Davos. I am wondering, Governor Sanders, given the fact that a lot of people didn't decide to make that journey, are you acting like an ambassador, fielding a lot of questions? What are some of the questions people have for you?
Certainly don't need an ambassador. President Trump will address the group here today, although he can't be here in person, certainly dominating almost every conversation, but not just here, across the globe. I think there is so much excitement, so much optimism about him coming back into the White House. People across the world are excited to see what he's going to do, and he's hit the ground running and gotten a lot done in a short amount of time. This is somebody who now is coming in as a seasoned veteran. He has been there before, and there's no learning curve. He is getting a lot of things done and in short order, and the people are excited to see what's happening.
Anne-Marie was just talking about some of the discussions around TikTok last night on Fox News, and this question around what is national security? How do you adequately regulate big tech when you have also this focus on celebrating the national champions of U.S. tech companies? You're here to talk about tech. How do you reconcile that?
You know, one of the things that we're looking at, and certainly one of the places that we're leading in Arkansas and as governor, is you can protect national security. You can look at continuing to grow some of the technology and innovation. But one of the places I think that we have to do a better job is on our young people. We've seen a mental health crisis take place. And nobody is immune from it. And so one of the things that we can do is a better job protecting the young people from constant access and infiltration of nonstop device in their hand. They still need to get outside. They still need to pay attention in class. That's one of the things we've been doing in Arkansas, one of the things that we've talked about here, and I think one of the things that I hope to see the United States lead on.
And as a mother and someone who sees a lot of children, I think there are a lot of people who would agree with you. There is this large attention, though, and last night we really saw that in display when President Trump was talking about they're just a bunch of kids looking at some silly videos. Do we really need to care about that so much? Do you agree with that premise, or is this something that goes to national security, but also the heart of something else about what it means to have appropriate technology?
Certainly there can be a great resource in technology. It's a tool that a lot of us use to, I think one of the reasons that Donald Trump became president is because he was able to use technology to get his own message out and go around the mainstream media and talk directly to the people. And so I think it can be a great tool. However, it can't be something that our kids are spending 10 hours a day doing. And that's one of the things I think that we have to look at. One of the things we're talking about a lot, the pressure, the anxiety, the depression, the suicide rates that have skyrocketed in large part because a total access and connection to social media. And so protecting kids, I think, has to be one of the big topics of conversation.
Do you think that President Trump agrees?
You know, that's a conversation I haven't had with him, but it's something certainly that I look forward to talking about with him as he takes the reins here at the White House.
Do you think there is clarity about what national security is and what isn't?
I think there are some big differences in kids versus national security and whether or not they can focus in the classroom and whether or not other countries are taking all of our data. Those are very different conversations. This is a president who I know cares a lot about protecting American interests and is always going to do what is necessary to protect our country. You've seen him taking action on day one, so I have no doubt, no concern over that. One of the things I do think that has to be a greater part of the discussion is the mental health impact that it's having on young people.
You're on two panels. One of them is talking about this. The other one is with Kentucky Governor Andy Beshear, who is a Democrat. And I believe you guys are staying in a similar place. And I'm imagining the Sharks and Jets walking past each other. It's a panel about the role of governors and states in presidential transition and implementing policy. And this comes at a time where President Trump has basically said, get on board or face the consequences. Do you think that that is the right way to get states on board?
I have a great partnership. I want Arkansas to be one of the leaders of a lot of the initiatives that the president is pushing. We're going to be one of the biggest champions, and I want us to be a place of innovation and use Arkansas as a pilot for some of the programs that we're rolling out. I think on healthcare, there is a lot of opportunity to do things in a better way than what we've done, and I think this is a president that's going to be able to do that. A good relationship with the states is a good thing. We shouldn't be in constant battle between the federal government and our state governments. And I think that's one of the things that you'll see both of us talk about, how we can have good cooperation and get things done that benefit the people that we govern.
Do you think it's a good precedent for funding to be withdrawn, though, from states that don't comply with certain orders from the president?
Look, I am in agreement with where the president is and the things that he's trying to do. And I think we're going to be able to not only improve things happening in Arkansas, but hopefully things happening in all 50 states. This is a president who's coming in with a huge mandate. People want to see his policies enacted. They know exactly what they signed up for because they've seen his leadership style, and he won in an overwhelming margin. And that's what people are hoping. He's going to come in and deliver on all the things that he's been talking about over the last couple of years.
Have you talked with Governor Beshear yet?
I haven't yet, but I'm looking forward to spending some time with him this afternoon.
But you guys both are the children of governors, I believe, and you both are coming to this stage, but from opposite sides, one Democrat, yourself a Republican. Do you expect it to be collegial? Do you expect it to be a working together kind of feeling, or do you feel like that divide is getting more entrenched?
Absolutely. I think that, governors have a unique perspective, and certainly I want to promote and bring business and economic development to my state. I know he wants to do the same, but there's some common threads and some common challenges that we're both dealing with. I think that we'll have a great conversation. I'm really looking forward to it.
One other reason why you're here is to meet with all these business leaders about potentially investing in Arkansas. Are there specific projects that you would like to see financed? Are there specific streams of business that you think would be helpful to get international investment?
Certainly one of the biggest areas of growth in our state is aerospace and defense. It's now the #1 export from Arkansas. Arkansas has the best economic growth of any state in the country over the last year. We're the #1 state for people to move into anywhere in the country. There's a lot of great things happening in our state. We like to tout that we are home to Fortune 1, a little retailer you may have heard of called Walmart. So we're not afraid of big business and success stories in Arkansas. And we have the opportunity to meet with a lot of companies and let them know that we're open and we're ready for them to invest and make Arkansas their home as well.
How many meetings are you having? How much did you get just an influx of people who wanted to meet with you? And did anyone surprise you, or any places surprise you where they came from?
It's certainly a busy couple days, and look forward to making them a really productive few days with a lot of good things to take back home to Arkansas.
Are you concerned, though, that there's this feeling that maybe the U.S. is putting itself first at the loss of other countries?
Not at all. I think it's important. Everybody is going to be competing for the people that they either govern or lead, and that's exactly what you're going to get in Donald Trump. It's somebody, he hasn't been shy about the fact that he wants America to win. There's nothing negative about wanting the best for your country and the people that you lead, and I think that people want to see him do that, and that's why he won re-election in such a big way.
Governor Sanders, really appreciate your time and you making the trek from Washington, D.C. to Davos. Not many people did that. Arkansas Governor Sarah Huckabee Sanders did. We look forward to hearing what you learn. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Hi, Lisa. Saudi Crown Prince Mohammed bin Salman told President Trump that he's willing to expand investments and trade with the U.S. by at least $600 billion in the coming 4 years. Saudi Arabia state media reported the prince told Trump by phone that the kingdom was eager to seize partnership and investment opportunities created by the new administration. President Trump's acting defense secretary is deploying 1,500 more troops to the southern border to comply with Trump's declaration of a national emergency. Robert Salesses said that he had also approved the use of military aircraft to assist with deportation flights of more than 5,000 illegal aliens detained by Customs and Border Protection. Fire crews are making progress containing a new fire that broke out in north of LA yesterday. The Hughes fire quickly spread to more than 10,000 acres, but is now more than 14% contained. About 50,000 people are under evacuation orders and warnings in the region. There is a chance of light rain across Southern California starting tomorrow. And that's your brief, Lisa.
Thank you so much, Danny. And let's hope for that rain, because that could make it a lot easier. Up next, tariffs and global trade.
If you're looking to take advantage of the United States through tariffs, which many countries do, you're in for a new rude awakening. We finally have certainty. If you don't disagree with the president, the one thing you will know is you don't have to guess where he's coming from.
Max Kettner calls it Goldilocks on steroids, which you could see in markets yesterday. You saw the S&P reach a record high in Europe. It's not far apart. Basically what you're seeing with yields just staying pretty constant. You saw a drop off in yields initially, but today just marginally higher. Meanwhile, not seeing that same kind of dollar strength that potentially could be disruptive, with the euro gaining just a bit, though the interesting focus is on the Bank of Japan, widely expected overnight in U.S. hours tomorrow morning for Japan to hike rates going against the ground, putting some sort of a threshold underneath the yen. Under surveillance this morning, tariffs and global trade.
We think that the next 4 years are going to be very clear. If you're a trader and you're looking as a country to do reciprocity with the United States, bottom line, you'll have a good environment. If you're looking to take advantage of the United States through tariffs, which many countries do, you're in for a new rude awakening in the United States. I hear people day in and day out talking about how wonderful things look going forward. We finally have certainty. If you don't disagree with the president, the one thing you will know is you don't have to guess where he's coming from.
There is still quite a bit of uncertainty around exactly how tariffs will be implemented, but possibly more important for a lot of people here at Davos, what that will do to inflation. Will it be inflationary? Will it keep rates where they are? Or will it potentially even increase the prospect of some sort of rate hike from the Federal Reserve? Joining us now is someone who focuses a lot on that macro environment as he invests in real estate around the world. He is Hines Global CIO, David Steinbach. David, thank you so much for being with us. I want to start there. We've talked a lot about how rates can remain where they are simply because nothing is breaking. The U.S. economy is doing just fine. So maybe this is the neutral rate. Do you think that we can see a real estate recovery at a time where rates may not go down at all?
I do. I think it's important to remember that we're almost 40 months into rates going up in the U.S. and a lot of markets around the world. And that's a very long time. And the bid-ask spread has been quite wide for quite some time. And so even in this moment, if rates stay neutral or even tick up a little bit, I think the market has digested where we are right now. And really, at least when we're underwriting projects, are very much focused on how we can drive rent growth in our buildings, increase cash flow, and we're reducing the amount of leverage we're putting on assets as well.
Hold on a second. You said something that I need to dig into. You think that this market is actually stabilized and adjusted to it. A lot of people think that the real estate market's completely broken. You're not seeing transactions. People aren't able to borrow money to buy homes. Do you think we've already seen the bottoming out, the washout, particularly in commercial real estate that some people are talking about?
I think we have seen the bottom, yes, in the U.S. I think this year we're going to see capital that is on the sidelines begin to come in. I think certainly here in Davos, everything I'm hearing is every marginal dollar around the world is looking at the U.S. as a significant opportunity. And again, we've had 35 months of the market being able to have that price discovery, and we've been waiting a long time. And I think this year is the year that we'll see a lot of activity.
We've seen a lot of activity in specific slices of the market. Data centers, we see this in warehouse spaces. We haven't seen it in, say, office spaces, particularly in second and third tier cities. And I'm just wondering, do you think that maybe it's gotten a little lopsided, that area that's been very popular stands to become less so, and maybe money flow into the office space?
I think there's still a big opportunity in data centers and industrial. Those have been big themes that have obviously carried the day for a long time now. And I think there's a lot of tailwinds that are really important to realize. I think for us, living is a top sector for us. The U.S. is about 2 million houses short, and we believe there needs to be a lot of new building that will happen. Retail is now a sector that we are very focused on. It has been challenged for so many years that the winners and losers have been sorted. And office for us actually is something that we are starting to look at. We're starting with credit in office today, but I could see as the year progresses us moving into equity.
So this is mostly in the U.S., you're saying?
Correct.
And I'm just curious, you talked about the multifamily homes or single-family homes even, and this idea of renting. And I wonder how much this is a structural change. We've seen, given the rise in rates and the increase in prices, there are a lot of people are locked out of home ownership, and we've seen an increase in renting, just structurally, and a decrease in home ownership. Do you think that that is a structural change that will continue to accelerate, even if, say, rates do go down, mortgages become more affordable?
I do believe there's some key demographic changes that are happening broadly in the West. It's happening in Europe, Australia, but also in the United States. And I think those demographic changes are also impacting what you're talking about. I do think openness to rental does give, there's certainly positives to it for a lot of people. And I think that the market needs to provide more rental housing that is attainable. And I think it's going to happen.
Do you think that there's actually more room to run in terms of raising rents? And I ask this because that's a main component of CPI, of the main inflation gauge that looks at consumer prices, and I'm wondering if that actually stands to increase.
More broadly, I'm concerned about longer-term inflation across many different sectors. So it's not only rental rates, it's other parts of the economy as well. I also think that there will be new corridors of demand that open up within cities. And so while rental rates obviously aren't going to be able just to infinitely go up in certain markets, but what we're seeing because of the demographic shifts, people are moving around and spreading out a little bit. And I think that's good for the market, and I think that will help provide more attainable housing as well.
One thing that's been a theme here at Davos is U.S. versus Europe versus rest of the world. And one thing that's kind of ironic is the more that people get excited about the U.S., the more they note that it's priced to perfection. And wait a second, maybe we should look elsewhere because they stand to do better, even if they just don't miss as much as people thought. Are you one of those who actually start seeing more opportunity in places like Europe?
We do invest money around the world, so we are an active real estate investor. We're in 30 countries, and we look at all the countries as where the opportunity is. Asia, for us, is our growth stock, and so we will stay active there. U.S., we will be putting a lot of capital to work in the U.S. I do believe that this is a great time. But Europe, what's interesting here in Davos, the negativity around Europe is it just cannot really be that bad. And I don't think so. And I think that, we have raised a substantial amount of capital that we're ready to deploy in Europe, and we will do that this year. We are going to be very selective, but when I hear capital pull back from a geography, it feels that way here at Davos. I don't think it'll end up being quite as bad as the sentiment is.
Are there particular regions that you're looking at more closely? And I say this at a time where the economic engines of Europe are actually sort of the sick dogs, and the ones that were the sick dogs are kind of the economic engines. I mean, are you following that trend?
It is interesting to see how Europe has behaved this cycle versus the financial crisis. In the financial crisis, it was really Northern Europe that had much more strength compared to Southern Europe. This time it feels a little bit inverted in terms of Southern Europe. For us, there's a lot of interesting activity right now in Spain and Italy and other places in those geographies. With that said, I do think that with the capital pullback, very interesting opportunities are going to open up in Germany. We're active in the UK as well. I think all those geographies will provide unique deal flow.
You mentioned the UK, and one theme that's come up again and again is just the debt and deficits of a lot of places. And I know as a homeowner that often the first place they go to is taxes on your home. And how much are you looking at some of these policies as a potential headwind to certain investments in certain places? I
think some of the headwinds you're mentioning are fairly ubiquitous in a lot of markets. You can add insurance to that. You can add, there's a lot of pressures on cost everywhere. And I think that is something that investors are broadly going to have to get their head around because it's impacting a lot of sectors. It's not just real estate, it's the broad economy. And further, I think the debt levels in many of the Western countries are going to put more pressure on interest rates in the long term. And so I think as we invest today, particularly in real estate, it's a longer term investment. You have to think about that horizon.
So what's your sort of base case or your stress tests in terms of the range of rates where you still are going to be above water?
We are using very conservative leverage now, and I think that's a little bit different than previous cycles where there was a bit more leverage in the system given the cost of capital. So we're being very conservative with leverage, and we're focusing very much on how much cash flow we can create when we actually make an investment. Predicting exactly where interest rates are going to be in 5 to 10 years is close to a fool's errand in terms of what's actually going to happen. But really preparing your capital stack for a range of outcomes and relying on income, relying on the actual real estate you're buying, that's what's most important.
So you mentioned Asia. Not going to let that go. Are you headlong into China, given the fact that real estate there seems to be on sale?
We have been in all those markets for a long time, including China, and we've had a lot of successful projects there. We right now are mostly focusing on India right now as the major growth component for Asia. China needs a bit more time, but India right now is where all the tenants that we have spoken to have really shifted into significant growth expansion mode, and that's where we're seeing most activity.
So are you staying in China? Do you think that there's still opportunities there?
Yeah, we're a long-term investor, and again, we've been in China for over 25 years, and I think you have to see the long term. But for us, again, right now, we're going to be mostly focused on India.
What's your main takeaway from Davos this year?
Well, it's interesting. I've been here several years, and I think the optimism here is palpable. And I think my only my only concern is when it's that positive, can it really be that good? So I'm actually feeling a little more just curious to ask some harder questions, but without question, I think 2025 is going to be a good year.
David Steinbach, thank you so much for being with us. David Steinbach of Hines, which oversees more than $90 billion. Coming up, we have Kruszewski, Stifel CEO, as we talk about bank mergers. You could see markets really embracing the optimism, although pulling back just a touch today. Ron will have a very interesting view on bank M&A in 2025. Yet another hat tip to Max Kettner of HSBC with the headline of the morning, Goldilocks on steroids. And certainly that was what we saw in markets yesterday. Today, pulling back just a touch, but yesterday the S&P hitting an all-time high. It is somewhat narrow, with a lot of that dominated by big tech. Really not a lot of action in interest rates. And that's actually a wonderful thing for people who are worried about the potential for inflation, just a tick higher right now. 3 hours away from the cash open. Let's get to some morning movers with Menace Cranny. Menace.
Lisa, good morning. Well, it may be bullishness on steroids. Have a look at this. Larry Culp says it was a monumental first year for GE Aerospace in their first year of independence. $1.32, way above the estimates of $1.04. A buyback of $7 billion for this year, and a dividend, raising the dividend by 30%. So this is about a company working through its supply chain issues. Those are undeniable. But to coin the CEO's phrase, a monumental first year of independence. Now, when you want to understand the personification, what do the risk of tariffs in Canada really mean? Think Alcoa, think about aluminium, and this is what they're saying. Tariff pain in the aluminium world would be it would have a quietening effect. 25% tariffs on Canadian aluminium would cost consumers $1.5 to $2 billion. It would be a real hit to demand. That is if it comes through. They did beat on their numbers, $1.05, way ahead of the S Street at 97 cents, and a revenue of $3.48 billion. But it is this worry, this overhang of what could come from tariffs. I'll leave you in the entertainment space. This is the games maker. You just think about Apex Sims, UFC. Those are the kind of games that they have. The net bookings, they guided lower, $7 to $7.15 billion for the year. And what you're seeing is some peak engagement in some of the games. Dragon Age engaged 1.5 million players in the third quarter. That is down nearly 50%. Global football, down mid-single digits. So this is about trying to understand where you are in the peak of some of these games and some of the software that's out there. Lisa.
Thank you so much, Menace. Right now, we are looking at markets that are trying to digest everything political. We were talking about Max Kettner of HSBC with his Goldilocks on steroids, basically saying it's not political. It's just simply that things look pretty good. And if you're looking for politics as a catalyst for something, if anything, it just keeps positioning in check. Well, one area where the president's policies definitely are gaining some optimism is the bank mergers and acquisition space and just the M&A space in general. Joining us now is someone who got the interest rate call right last year. He is Stifel Chief Executive Officer Ron Kruszewski. Ron, thank you so much for being with us. So just how bullish is it?
You know, it's pretty bullish. I mean, when you look at everything, I'm surprised walking up here. I haven't seen more people doing dances walking out of here. I mean, it's pretty bullish. And you know what? I'll tell you the one thing that could be the canary in the coal mine. You brought it up here. We need to watch the 10-year, okay? A lot of people are going to talk to you. The bill's going to get through Congress. This is going to happen. The one thing that is going to be sort of the governor is the bond vigilantes, okay? So if policy gets out of whack here a little bit, you'll see it in the 10-year, and then that could give a little difficulty in equity market valuations. But other than that, I'm telling you, things are pretty positive.
Okay, so this is sort of the fly in the ointment. We've heard this from a couple people. I just wonder what you make of the rally that we've seen in the 10-year over the past week or two, where people basically are saying, you got Scott Bessent, who's going to rein things in, make things rational, and they'll get something through. Do you think that that's too soon, too optimistic?
Well, I hate arguing with the bond market. I think that the rally probably does have a little bit of optimism in it. I think really the deregulatory bent really can be disinflationary in terms of just taking some costs out of the system. So there's a lot of optimism about that. And so I think the 10-year right now is giving all the right signals.
All right. Meanwhile, you are seeing that deregulatory impulse. You know, one thing that I find interesting is the transactions that you yourself have done have not all been focused in the United States and actually just closed on a European middle market investment bank. Why Europe? Do you think that there's actually more opportunity here at a time where everybody is sort of decrying its demise?
You know, we're here in Europe, but I must tell you, my board looked at me and said, why Europe? I mean, they said, you know, that, and I'll tell you why Europe. It's been pretty depressing over here, and I think it's a good time to invest, I'll tell you. And you know what? The European, I'm listening to the banks here and I'm listening to people here in Davos, and they're echoing the fact that they want deregulation too. They want a better business environment. So I think there's going to be some overflow of U.S. policy into Europe, which is going to bode well for European business activity in general, specifically M&A. So, you know, we're always investing, and why not?
Okay, hold on a second. You've had a lot of conversations with a lot of potential people in regulatory bodies as well as government in Europe. Do you actually think they're going to do this?
Well, I think there'll be pressure to do it. Whether or not they'll do it is the risk in the deal. I think it'll take longer, but even if they don't, they're going to lose market share to U.S. companies. Let's just call it what it is. So if you want to say we're not going to do it, I'm going to say, well, that's even more bullish for the United States international companies.
Would you be interested in doing more deals in Europe?
I'm always interested in doing deals, but in Europe, you know, again, my board will fall over if I keep. You know what? There is so much to do in the United States, and we haven't talked about where there's going to be a big boom, and that is in M&A. I mean, M&A in the United States is poised to have a phenomenal year. Last year we talked, and I told you 2024 would be a transition year, and it was. Deal volumes were actually down last year.
You can take a victory lap. Go ahead.
I'm going to take a victory lap.
Okay, go ahead.
But you know what it is? Today, look at the banks, for example. You know, at KBW, we are the leading bank advisor. We have #1 market share. So we have a viewpoint into what's going on. There are 8 changes in the regulatory bodies right now. And in one industry where personnel is policy, it's banks. So the environment coming up for bank M&A, which has really been, if anything, strangled by, frankly, the prior administration, who did not like mergers, didn't like bank mergers, that's changing.
Can you give us some sense of what scope of M&A we could potentially see? We've got some 4,000, more than that, community and small and mid-sized businesses in the United States. In a year, 2 years, 4 years, how many do you think there'll be left?
That's always a great question. Okay, I can confidently say there'll be less
Come on.
I know, I'm not going to give you a number, but you know what? What the financial services industry needs to do is it needs below the big SIFIs. Okay, so who has grown? The biggest banks have grown, and I actually think that's sort of bad policy. We need our champion banks, we need our JPs and bank. Don't get me wrong, but we need the regional, the 50 to 100 to 120 billion dollar banks to be able to combine. They need to have innovation and scale to compete, and it's good for the U.S. economy. So I am optimistic that banks will combine for those reasons, and it's going to be powerful.
Are you concerned about some of the commercial real estate portfolios and the balance sheets of some of these banks in the meantime? And I say this because, you know, we have some people saying that you've seen the washout, other people saying you really haven't, because it's not a market. There haven't even been transactions in a lot of these pockets of commercial real estate. Do you think that's going to be a bit of an issue?
You know, a year ago, I would have said yes. Today, I think that there's a lot of things that are going back against that trend. Number one being people are coming back to work. You know, the whole idea was you don't need real estate because no one's going to come back to work. Well, most companies are now coming back to work. President Trump says all federal government people are coming back to work too. So is it still a pocket of concern? Yes, but I think less so today than it was a year ago.
Is Stifel all back to work in the
office?
We are.
You know what? We have been. I mean, we can't compete. We can't compete remotely. I mean, I'm all for work-life balance, and we have situations where we'll do that. But we are a collaborative, innovative firm, and we need to be together. So, yep, we are.
Okay, Stifel has been a huge acquirer of other companies in a merger in its own right. You talked about Europe, but what about the U.S.? Are there certain pockets of opportunity that you're looking at more closely?
Well, the wealth space has been probably our strongest growth, you know, and to give you a sense, I like to take an opportunity to just talk about our growth. You know, I joined in '97, so I've been around a while, and we had $100 million in revenue. We'll do almost $5 billion this year, mostly driven by wealth, just helping people plan, and that's what we're really good at Stifel, and I see continued opportunity to grow in that space.
So this is an area for a lot of people. This is highly competitive, and I keep hearing about it, whether it's Citi that's creating their wealth unit, whether it's Morgan Stanley, UBS, all of them trying to really lean into the wealth space. Why is it so important now as a ballast to a lot of banks that traditionally have been lenders?
Because it is a stable, fee-based business. It doesn't have a lot of risk, and so when you and it's the same customer base, and so the banks have realized that. They've been leaning into this for a while, so that's not a new phenomenon. I think culturally we have an advantage, so even against the biggest banks, and so I like that business.
So President Trump is going to be addressing the Davos crowd today, 5 p.m. local time. Yep. We've got 11 a.m. Eastern time. What are you curious to hear from him?
I just think I'm curious to hear some optimism. I really am. I felt that some of the things that have happened in terms of, I don't agree with all these pardons, but since they're all out of the way, maybe we're not going to be worrying about the judicial side of a lot of things. Let's focus on economic policy, and I hope he has a positive message for the people here in Davos, which I'm confident he will.
Yeah, was there anything particularly interesting that stuck out to you about what you heard here?
I think here, I'm just reporting here. I don't want to make any political statements, but I will tell you there were every meeting last year was DEI and climate, and it's really not top of mind here this year. Now, is that good or bad? We can all have our viewpoints, but I will tell you it's noticeable to me the amount of discussion here that is economic based.
And encouraging?
It is for me.
Ron Kruszewski, thank you so much for being with us today. Stifel Chief Executive Officer Ron Kruszewski here in Davos. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Hi, Lisa. Secretary of State Marco Rubio is planning his first trip since his confirmation. Rubio will reportedly travel to Panama as early as next week, underscoring President Trump's seriousness about taking back the Panama Canal. Sources say that Rubio also plans to visit Guatemala, El Salvador, and Costa Rica. Elon Musk is already expressing skepticism about the Stargate project announced by President Trump earlier this week. Musk questioned if the companies, which include SoftBank, OpenAI, and Oracle, actually have the funds for the AI investment effort. OpenAI CEO Sam Altman said Musk was wrong and suggested that he was upset because the pact could rival his own AI efforts. Parts of the southern United States have seen their worst snowstorm in 130 years. As much as 10 inches of snow fell in New Orleans, smashing a record of 2.7 inches set in 1963. Similar accumulations were recorded in parts of Florida. Houston, Texas was hit by more than 4 inches. Airports are struggling to keep up with the weather, leading to the cancellation of more than 1,800 flights. And that's your Bloomberg Brief. Lisa.
Thank you so much, Danny. Up next, taking risk.
I think it's a good but not amazing time to be taking risks in the market. When you take into account what's already happened to risk premiums, how much is baked in, you've got to say, well, it can't be great.
That was a great party last night. That's all I can say, Brahma.
Oh, yeah. Here you come. Who are you?
What have you told him? Where have I been?
Yeah, well, you've been partying. You've been skiing.
Okay.
You've been ice skating. You've been examining the snow, taking measurements of all of the snowflakes.
Nice.
Yeah.
Okay. Is that what I do in my spare time? Okay, I appreciate that. Have you done any market checks?
Yeah.
Should we do one?
Really?
Okay. We're down 0.1% on the S&P. Under surveillance this morning, apparently, taking risk.
I think it's a good but not amazing time to be taking risks in the market. When you take into account what's already happened to risk premiums, how much is baked in, you've got to say, well, it can't be great. You could have a pretty great year for the U.S. economy. You could have U.S. companies keep being really productive, keep returning money to shareholders, and it not be an amazing time to be an investor because it was already baked into the price.
Just had a great conversation about this downstairs in the World Economic Forum. Bramo, I know you followed a little bit of it. It was interesting when we got into US exceptionalism, and Katie Koch at TCW, who we'll catch up with a little bit later on this morning in the next 30 minutes or so, making the case that, yeah, sure, things are pretty good and they might get better, but how much of that is already fully priced? Just that little bit of caution that I haven't heard too much of in Davos over the past few days. Heard a lot of it in the last 60 minutes.
And you're seeing this in people looking to other places that maybe are just lower priced, not even necessarily where there's more optimism, which is why you saw the DAX, why you saw some of the European stocks in regions, in parts of Europe that actually aren't aren't doing that well. Soared to near record highs yesterday because of this exact dynamic.
Second best on that panel joins us now, after Katie, of course, the General Atlantic CEO, Phil Ford.
Still joined us?
Phil, good to see you.
I'm happy to be second to Katie.
Happy second to Katie, of course, of course. Bill, let's build on what we've already talked about this morning. A lot of the audience followed some of those comments on Bloomberg Television. That note of caution, yeah, sure, things are great, but markets are pretty fully valued.
I think it's true. I mean, values are in the top 80, 90th percentile, or if you look at a 10, 20-year history. So a lot of the excitement about the U.S. is priced in, and I think as we talked about this morning, I mean, there are three big drivers which gives you a lot of optimism about the United States. Energy security, tech innovation, and capital market leadership. Those are all true, and I think they all create a real sense of opportunity. But again, it probably priced in. I think we had a good conversation about some of the risks related to the trade deficit, the budget deficit that need to be addressed.
Let's talk about some of the opportunities as well. A lot of people want to get into your world. Private markets, it comes up all the time. What does that mean for the kind of strategic risk that you take as a firm?
Well, as a firm, we're focused on innovation, entrepreneurship around the world. And I have to say, there's no shortage of terrific entrepreneurs, no shortage of good ideas. So our pipeline is pretty rich right now. And again, I think we're at an incredible moment of inflection in the technology space. And turns out this is the fifth major tech cycle of my career. I think back to the PC cycle of the 80s, the internet cycle of the 90s, the mobile cycle of the 2000s, and then cloud in 2010, and now we have AI. It's the fifth big cycle, and this one is probably the biggest in many ways, and it's going to have the most profound impact. But what that often does, it sort of rewrites winners and losers, creates opportunity, and we're at the early stages of that. So I think this will play out like all those cycles over 10, 20 years, not over 1 or 2 years.
There was a huge pipeline of private tech deals that were supposed to IPO, and then the pandemic hit. And they haven't IPO'd. And a lot of people are saying the reason why they haven't IPO'd is because they don't like the prices they're going to get. Do you think that that's been washed out of the system, or do you think that there's still some reckoning there?
I think we're going to have an IPO renaissance right now. I think we've had 3 of the toughest years on record for IPO activity. And I think it was a combination of things. I think it was an over-regulatory environment in the U.S. and from the SEC. That was one thing holding people back. Second was maybe a post-COVID lapse. 3, there was a lot of capital in the private markets that was available for companies that they were taking advantage of. But I think we're at a moment in time where it's time for the IPO market to open back up. And there are 3 ways to win. Basically, the companies can raise capital. And it's been a while since they raised capital in 2020, 21 at the market peak. Second, it gives the public a chance to invest in some of the most exciting growth stories that they've been really shut out of for a while. And, of course, for our private market investors, it gives them a chance for liquidity.
It seems like there's a real tension right now in Washington, D.C., because Donald Trump has been talking about national champions in the big tech space. Yeah. At the same time, that there are real questions around what national security is, et cetera. Do you have a clear sense of the difference?
Well, I think he's right to point out that if you look at like the top 5 or 10 tech companies in the world, most of them are out of the U.S. and they're homegrown and they've been successful and they've emerged as global leaders. And I think he's right to champion those companies. I mean, he's of course worried about power and scale and all the usual things. But I think generally speaking, he's looking to stimulate investment in the United States and really foster more innovation, more growth.
He's playing a big role in the company that you're on the board of. And we talked about this a little bit already in Davos, Switzerland. We'd love your opinion right here on Bloomberg Surveillance. What has the last few months been like, being on the board of ByteDance?
Well, I mean, since we had legislation passed in the United States that really would effectively ban TikTok if we didn't come up with a solution, and it was really around national security, we've been highly focused on trying to develop that solution. And we were very grateful to President Trump for intervening and keeping TikTok available. And the company really wants to engage with him and develop a solution. And I think we're quite optimistic we'll find a solution.
Do you think that solution is going to involve selling the U.S. assets to a U.S.-based company or individual?
I think there's a number of alternatives that we can talk to President Trump and his team about that are short of selling the company, that actually would allow the company to continue to operate, maybe with a change of control of some kind, but short of having to sell.
Do you think that the Chinese government would allow that?
I think so. I think that I'm optimistic about the dialogue that's emerging between President Trump and President Xi, and that might help create a much more constructive environment, a much higher level of engagement that could lead to a positive solution.
How unique is this moment with regards to being on the board of a company and needing the input of both the Chinese leader and the American president? How unique is that? And do you see that model being replicated at all with the likes of, say, Meta, who cannot get into China right now?
Well, I think what we're seeing is you know, what ByteDance really is and TikTok is, it's a global internet company with Chinese heritage. And I think we're going to see more examples of global companies coming out of China. And they're going to have to confront some of these geopolitical issues and navigating the U.S. government and the Chinese government. And I think it's going to be something that we're going to see more of. And again, my hope is that with better engagement between the Trump administration and the Chinese leadership, we'll actually find more common ground going forward.
One thing we've witnessed over the past few days, and Lisa and me have been talking about this, the perceived disconnect between the headlines we're having out of Washington, D.C. on trade, and then seeing equity markets in Europe at all-time highs. You've struck a note of optimism regarding trade this week. In fact, I would say optimism around the incoming administration, the new Trump administration, almost across the board. You've mentioned that already this week. Can you build on that? Where does that come from?
Well, I think, first of all, I'm very excited about Treasury Secretary Besson and his agenda. I mean, he has his 3 threes, which is 3% economic growth, get the deficit down to 3% as quickly as possible, and increase energy production by 3 million barrels. I mean, I think those are very, very positive for the U.S. economy and for the outlook. So I think that's a good thing. And I think, you know, the Trump policy agenda, I think is going to be one that's pro-business, pro-growth.
What's fascinating to me is not necessarily the reaction to President Trump from the United States, but from Europe. And that actually people are so down on Europe. And when you talk to different executives, they're actually getting more optimistic that there actually will be change in Europe, that maybe now is a time to be invested. Are you one of those people?
I am, Lisa. And I have to say, in my conversations with CEOs in Europe, they want a catalyst for change. They want regulatory rollback. They want a more constructive business environment. They want to be global champions. There's some terrific companies in Europe. Many have been held back by excessive regulation. It's held back investment. It's held back innovation. And they want that to change. So I think they're welcoming a catalyst coming out of the U.S. that may push for change.
Are there specific areas within Europe that you actually think are ripe for investment? And I say this at a time when people are talking about where is that tech dominance coming in the continent?
Well, I mean, we've been investing in Europe for over 25 years, and it's always been about 20 to 25% of our portfolio. So despite sometimes the doom and gloom, there's a lot of terrific entrepreneurial companies in Europe, in the internet sector and even the software sector. So I don't want to lose sight of that. And there's some, Europe is full of human capital. There's a lot of talent here, and there's plenty of good entrepreneurs. Again, I think they're held back by the regulatory environment. I think they're held back by not having a single consolidated capital market where companies can go public like we have in the U.S. I think those are detriments. But at the ground level, they're entrepreneurs, they're high-quality companies, and there's innovators here, too.
Are you confident we'll see that cultural shift? The governor of Spain talked about that earlier this morning. Are we going to see that cultural shift where Europe starts to embrace failure and doesn't punish success?
I hope so. I mean, again, I am seeing more young people across the continent being willing to start companies, and there is venture capital and growth equity capital. You know, like I mentioned, we've been active here, available for companies. I wish they had a bit more of a risk-taking culture. I wish that we had a better IPO and exit environment. We don't have a consolidated capital market in Europe the way we do in the U.S. I think that's a detriment. That's why many of the companies choose to go public in the U.S., even from Europe. But maybe that will change.
Bill, got to do this more often. Not just once a year. Bill Ford, the General Atlantic CEO. Bill, appreciate your time, sir. Thank you. Thank you very much, sir. Coming up very shortly in the next hour of Bloomberg Surveillance, we'll be catching up with the Saudi Finance Minister. Jumaane Bashaghi is going to sit down with the Finman in just a moment. And then after that, the TCW CEO, Katie Koch, ready to go. Looking forward to talking about private markets with her. The Boston Celtics co-owner, Steve Pagliuca, also co-owner of Atalanta Football Club, which is having a wonderful season.
I think I remember you mentioning that once.
We'll be talking Italian football a little bit later, other things too. And look out for this conversation with Joe Taylor, important conversation about the relationship between the United States and Canada, the Ontario Teachers Pension Plan CEO. From Davos, Switzerland this morning, good morning to you all. This is Bloomberg Surveillance.
You clearly have an administration that wants to use fiscal policy.
When you have a messaging from the top in the United States around pro-business, that causes investment.
I'm optimistic on a lot of policies that are coming together.
We think that the next 4 years are going to be very clear.
There is questions around the geopolitical landscape is probably the biggest one, tariffs in particular.
This is Bloomberg Surveillance, live from Davos, with Jonathan Ferro and Lisa Abramowitz.
Live from Davos, Switzerland, at the World Economic Forum on the final day for us here at Bloomberg Surveillance. Good morning to you all. Once again, that word on repeat, optimism. People optimistic about the future. And there's been a real shift. And it's taken, what, 3-4 days? All of a sudden, people are talking about a different Donald Trump presidency, one where we'll solve some of these issues. Bramo, the trade story. Yes, Europe's going to get it, apparently, maybe. And at the same time, equities are at all-time highs. And I think we've heard that on repeat, Lisa, over the past few days.
Yeah, and there's a real tension here. How much does it have to do with Donald Trump, and how much does it have to do with the underlying momentum in the economy that will be turbocharged simply with the reduction in regulations, which is basically gaining steam throughout all conversations? I talked about Max Kettner, Goldilocks on steroids, this headline that I think he might have written.
I saw the note.
With us in mind. But he was looking at how it's not because of politics. It's because basically you're looking at a strong economy. And if anything, the political uncertainty will keep sentiment in check.
Number one risk, though, it's come up time and time again. The number one risk, a fiscal deficit on steroids. And how close are we, Lisa, to that moment of reckoning? I think it was Katie Koch we'll catch up with a little bit later from TCW, who's looking, Lisa, for the potential, not a base case, but a worry that you do get that failed auction and this story changes and changes quickly.
The bond vigilantes certainly are the black cloud hanging over some of the enthusiasm that we're hearing, because if yields do surge, that could potentially stymie some of the opportunities that everyone is saying, whether it's M&A, whether it's deals, whether it's investment, that are on the table.
Lisa, doom and gloom with a smile. It's what you can expect through the next couple of hours here on Bloomberg Surveillance.
And weeks.
Yeah, and years. It's going to be a long career. Doom and gloom with a smile. Katie Koch joining us in about 10 minutes' time. Don't miss that conversation. For now, though, a really important conversation. Bloomberg's Jumana Basechi leading our coverage out of Dubai with us here in Davos, Switzerland, and sitting down with a special guest. Hey, Jumana.
Hi, guys. Yeah, good morning to you. Sitting with me right now is His Excellency Mohammed Al-Jadaan, the Saudi finance minister. Really good to be talking to you. My colleagues in the U.S. were just talking about the excitement many people, many industry leaders feel about the prospects for the U.S. economy this year. But my question to you is, how does the rest of the world feel about it? What do you think the return of Trump means and his talk of tariffs for global growth?
Thank you very much for having me. And I think a very strong U.S. economy is a good thing for the world and the world economy. The same applies to other major economies. If they go south, the whole world would really feel it. So we are excited.
As the world gets cold. Yeah.
Exactly. I mean, we are excited about the U.S. New administration, and we are excited about the U.S. economy. We think the next few years would actually show strength in the U.S. economy, and if that will be good for the whole world. Obviously, we need to be watchful. We need to make sure that we also support cooperation and multilateral institutions. But I am confident that the U.S. economy would be positive, and I think the IMF in their latest report showed that the U.S. is on the upside.
It seems like His Royal Highness the Crown Prince had a constructive call with President Trump yesterday. Lots of reports this morning saying that Saudi plans to invest up to $600 billion in the U.S. over the next 4 years. For people not familiar with those figures, that's about 55% of Saudi GDP. You're the finance minister. Where are you going to get that money from?
Saudi press agency actually issued a statement on this. We enjoy a very strong relationship with the U.S. over the years. I mean, we have a relationship that spans over 8 decades, very strategic, based on economy and trade, and will continue. I mean, currently we have over $770 billion of investments in the U.S. So this is not really new. This is a combination of investments and procurement. We have very ambitious plans in Saudi Arabia. The Saudi Vision 2030 is moving on plan, and our relationship, whether it is with the US, with Europe, with China, will continue to be flourishing as part of that reform that we are doing.
Yeah, I guess I just think about it from a funding perspective, because there are mega projects that Saudi Arabia has committed to, and we've talked about the reprioritization of goals and the redirection of funds over the last year. But then there are new projects that Saudi is taking on as well. The World Cup, for example, Qatar spent $200 billion on that. So the question, I think, from the investment community is, if you are planning on borrowing more, how much balance sheet deterioration are you willing to tolerate?
We have, in Saudi Arabia, we have very strong, actually, fiscal buffers, very strong. And we are very, very careful about what we spend, how we spend it, and the return on that spend. We have a very clear plan. We moved from just 3 years fiscal plan into actually a long-term fiscal plan. We've concluded this last year. So we know exactly what we are going to spend, where are we going to get that money from, how we are going to make sure that it helps the economy and not crowd out the private sector. That is a long-term plan. And all of these projects will fall in place within that context. We recalibrated what we need to do. We wanted to make sure that we prioritize what would make matters. We wanted to make sure that we don't overheat the economy, so we extended some of these projects over an extended period of time. And we wanted to make sure that our private sector benefits. So if we do too much at a short period of time, the private sector will not catch up. So we will have a lot of leakage from our economy by importing a lot of things. So we wanted really to balance it, and that's what we did in the long-term plan. I think if you want to see how this actually is reflecting in Saudi, you will need to see what is happening with the people in Saudi Arabia. They are embracing this change. I mean, if you visit and you could see it, they are really part of that change. You could see it in the PMI and the Purchasing Managers Index, which is very high.
I'll get to the growth question in a second, but I do just want to ask on the funding. Can we expect further sales of the government stake in Aramco?
There is no extra funding than what we have planned for the long-term plan. And, Aramco or other assets is part of a plan. So there is nothing immediate to talk about, but it is actually part of a long-term plan that we started in 2016.
Yeah. On the growth, IMF actually marginally downgraded the Saudi estimate for this year, looking to 3.3% for 2025, and partially on back of Saudi's lower oil production. And of course, this was a decision taken by OPEC+. And I just wonder how long you think Saudi Arabia can continue with producing less and yet continuing to achieve those non-oil GDP figures that you target?
This is actually a very good question, spot on. And I think the whole idea behind Saudi Vision 2030 is exactly this, is to deal with these things. We were an economy that is totally dependent on one commodity, and the volatility of that commodity impacts the economy. It's the boom and bust. We are decoupling the Saudi economy from the oil economy, okay? And you could see that in actual numbers. I mean, numbers does not lie. The non-oil GDP part of the economy is now about 52%. The private sector investment as a percentage of GDP has seen a structural change. You don't see private sector investment as a percentage of GDP changing very quickly in any economy. We are seeing that in Saudi Arabia. It jumped from about 17%, now it is 24%. That is a serious shift in the economy. The consumption is very strong. I mean, you look at the confidence, both at the business side, but also at the consumer side, it's very strong.
Yeah. Your Excellency, just to round things up, Saudi Arabia for so long has been a place where investors from around the world have come to receive funding, to receive capital. How successful has the kingdom been in terms of mobilizing these funds domestically and encouraging the international community to actually invest into Saudi Arabia?
Very important point. A lot of focus on FDI. I'll cover FDI, but I will cover actually prerequisite for the FDI. For FDI to come, you need to make sure that actually you attract your own local investors to invest in your economy. These are their colleagues, their friends, their partners elsewhere in the world. And if you are not able to convince your local investors to invest, you will not be able to convince the foreign investors. And we are achieving both. I think we are seeing significant growth in local investments in Saudi Arabia, and we are seeing, I think MISA, the Ministry of Investment, published a few weeks back what is the targets under the Saudi National Investment Strategy over the last 4 years, and what have we achieved in terms of FDI. And every year, without fail, we came ahead of the target. And that is continuing. I think Saudi offers significant opportunities for investors, local and international, in multiple areas of space where we have competitive advantage.
Your Excellency, I'm going to leave it there. Thank you very much for sharing your perspectives about the outlook for the Saudi economy and funding as the kingdom continues to implement Saudi 2030. I'll hand it back to you guys.
Hey, Jumana, appreciate it. Fantastic conversation. Jumana Basechi there of Bloomberg, leading our coverage out of the Middle East here at the World Economic Forum in Switzerland, sitting alongside the Saudi finance minister. This whole forum will pause a little bit later on this afternoon, as I'm sure you've heard. Lisa, that address coming up from the President of the United States from Washington into Davos, Switzerland, just hours away.
Yeah, 5 p.m. It'll be eating into some of the happy hours over here, 11 a.m. Eastern time. The questioning from key executives is actually fascinating to me, especially because, yes, you have your Brian Moynihan of Bank of America, you do have your Americans, but you also have Anna Boten of Santander, you have the Total Energy CEO, you have a number of different people who are going to ask some real questions and maybe get some real answers. They say it's going to be 45 minutes. You think that?
You say ask real questions. Can we just pause on that?
Okay, maybe you're right.
You know Access Journalism, where you get those soft questions?
No,
you certainly don't know about it. Some other people might, outside of these particular walls anyway, other networks. They ask soft questions to get that access. Are you telling me that these CEOs are going to ask hard questions of Donald Trump at a time when they want access to the administration and the U.S. economy?
Okay, fair. There has been a lot of soft peddling and a lot of nice talk toward the president, hoping that they don't invoke the ire of the president. Maybe that is one of the executives flying in right now to get some access or flying to D.C. But there's a real question here about what tariffs look like, about what kinds of policies are going to be around trade, about what taxes are going to look like. There are a host of different policy-focused aspects that are looking for clarity. That's what I'm expecting to hear.
Let's see if we get a bit of that in a few hours' time. I hope we do. I hope we do.
What are you going to get?
We'll see.
I think you're amazing.
We'll see.
Thank you.
Like bowing down, that kind of thing.
You think that's going to happen?
No. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Sticking with President Trump, he is planning his first visit not to Davos, but since returning to the White House. Instead, Trump will be heading to Asheville, North Carolina, which is still recovering from Hurricane Helene. Then he'll head to California to survey the damage from the Los Angeles wildfires. Looming over his trip are questions about federal funding for disaster recovery. Some earnings to get through. GE Aerospace, those shares rallying in the pre-market 5.8%. It beat estimates for both profit and sales for the final quarter of the year. GE Aerospace also announced a $7 billion buyback, underscoring a company that's been able to navigate supply chain limitations. It was also able to take advantage of strong maintenance backlog. Now, breaking moments ago was American Airlines earnings, those shares falling nearly 7%. It forecast a surprise loss for the coming first quarter. That loss will be as much as 40 cents a share. The expectation had been a 1 cent profit on average. It is a break from its rival carriers who had been cashing in on unusually strong winter demand. And that's your Bloomberg Brief. John.
Hey, Danny, appreciate it. Thank you. Some movers out there. Want to pick out one of them. American Airlines coming out with some numbers just moments ago. And Lisa, those numbers, not pretty.
Yeah, Danny's showing the down almost 8% in pre-market trading. Looking at some kind of loss is 40 cents on the share in the current period. The interesting part about this is how different it is from some of the other airlines, whether it's Delta or United. It has to do with deliveries that were delayed. But it shows it isn't all smooth sailing or smooth flying for some of these airlines. I can't even believe I just said that.
Well, you did, and here we are, and the stock is down by close to 7% in the pre-market. This week in Davos, Switzerland, a big discussion, not just about the markets and the economy or flying, on the future of AI.
We're beginning to see the enterprise customers actually spending on infrastructure to support AI and or modernizing their infrastructure in preparation for AI. Enterprise customers are really looking for partners to help them understand how to navigate this and how to actually deploy this stuff, and we're going to play a big role.
Let's check out the equity market, equity futures so far this morning, and good morning to all of you stateside just waking up. Equity futures on the S&P 500 doing okay. We're down just 0.2%, no drama there. Had a decent run over the past few days. Over in Europe, we've seen a really, really big run. Record high after record high in the last 24 hours or so. In the bond market, yields just starting to creep higher again, Lisa, up by 3 basis points. The 10-year 464.
Yeah, and this comes after actually rallying. And there was a question here, and Ron Kruszewski, of Stifel was talking about how maybe there's a lot of optimism baked in, that maybe there won't be some sort of extension of debt and deficits, but still a big sort of uncertainty hanging around that space.
The data point of the morning is not jobless claims at 8:30 Eastern time. The data point of today comes a little bit later on when we get the address from the President of the United States, Donald Trump, into the World Economic Forum here in Davos, Switzerland. We've all been whipsawed by trade headline after trade headline, but there is a feeling, essentially, so that maybe you don't take those headlines too seriously. At least that's the way the equity market and foreign exchange has behaved at times.
Which is the reason why so many people are looking at not just the words that President Trump says, but the fact that he is addressing Davos, that he finds that important to do, and exactly how he characterizes his relationship with the rest of the world, when the rest of the world certainly is listening.
We're going to have a big conversation about financial markets in a moment, but we have to start with something much more important. TCW CEO Katie Koch joins us now for more. Katie, it's good to see you.
Good to see you both. Thank you so much for having me here.
Thanks for being here. Super strong ties to Los Angeles. Let's
Yes.
start there. It's important. How bad have things been? Give us an update.
Well, thank you for asking about that. TCW is a global asset manager headquartered in Los Angeles. We have 480 families that are based in LA County, and it's been really difficult. We have 5 families who have been permanently displaced. I've been talking to other CEOs here. Many of them have been impacted by this as well. My family has been permanently displaced, and it is tough. And I would say what I want to kind of focus on here is the fact that the community has really come together. I'm so proud of the way the TCW people have come together to support each other and work through this, and I know other CEOs feel the same way. And for me, it is personal. While we did lose all of our things, the thing that we're really grieving as a family, and it's different for every family, we're very fortunate we had insurance. So thank you, Goldman Sachs, ACO, Pure Insurance, and our broker, Willis Towers Watson. We can replace. We're very fortunate. But what we're really grieving now is the Pacific Palisades community where we lived. And you guys know my family pretty well. I had the great privilege of working at Goldman for 20 years, had the opportunity to move to LA to work with TCW. I took that opportunity, but I had to bring the 4 kids and the husband across the country, and you would know this. I feel guilty about that because I'm pursuing my ambition. My family has to come along, and we get to the Pacific Palisades, and we just felt at home. The people are extraordinary. They've educated my kids, coached my kids, opened their homes to my children. And one thing as a working parent you guys would appreciate is that I can't be there for every moment of my kid's life. I can't do this job and be there. Yeah. And there are so many times where I was traveling and I would see a picture of my kids at the chapel or at drop-off or pickup because those parents in that school did that for me and sent those pictures, and I'd wake up. And that's my special connection to the community. There's thousands of people across Los Angeles that have their own special connections. And so we have to rebuild. We have to rebuild because it's economically important. Los Angeles, the GDP of Los Angeles County is bigger than Switzerland, so it's economically important. And because we need to, we have to reestablish these communities. And I'll just end by saying, I am a believer that when things are difficult and people come together, you're able to tap into resilience and courage in an extraordinary way. And I think that's what everybody's going to see from Los Angeles in the coming years.
Well, I'll say this on your behalf. You're one heck of a resilient person.
Thank you.
Lisa, we've talked about this, the scale of the devastation. When you compare it to the nation of Switzerland and the Swiss economy, I still don't think many people outside the United States understand what's taken place in Los Angeles over the past few weeks.
Yeah, devastation at a time where there still are active fires and there's a real question of getting under control, but also opening up larger conversations about how to rebuild and how to rebuild smarter at a time when this is an issue that will continue being a problem going forward. I mean, this is really clearly not something that can just sort of be forgotten.
Yep. That's right. And I'm highly optimistic we're going to come together. We're going to tackle it. We're going to use ingenuity and shared love for each other in Los Angeles to rebuild. I'm very proud to be here representing TCW. Well, also looking forward to getting home to see those kids.
I have no doubt about that. I have no doubt about that.
By the way, I learned something new about John. What's that? His mom watches this show for a half hour every day to connect with him.
Just 30 minutes.
30 minutes?
So she feels like I'm still there.
I love that.
I love
number
that
one
too.
fan. I hope she's watching right now.
I hope she is too. If not, I'll clip this for her. You've been generous with your time.
Yeah.
We'd love to talk to you about financial markets as well, if we can.
Yeah, of course.
Let's talk about the US economy and the word that you mentioned just a moment ago, optimism.
Yeah.
There's a lot of optimism around Davos, Switzerland, but a note of caution from you about how fully priced that might be in financial markets. Give us some color on that if you can.
Sure. So that is the mood. I've been watching some of the people, you guys have been doing a great job covering this, that you've interviewed. And so the dominant mood is extreme optimism, executives especially. What we're hearing is that this is going to be a very pro-business moment for America. Animal spirits are going to keep going. M&A cycle, obviously, part of that being reignited. And what I was saying to John earlier is that, I think that's all possible, but we're in the money management business. We have to actually create returns for our clients. And so for us, it's what's priced in. And the market's already priced like this. So a lot of that optimism is priced into the markets. And this idea of U.S. exceptionalism, just to put that into context for people, just factually, the U.S. has demonstrated exceptionalism. We're 4% of the world's population. We're 20% of GDP. We're 68% of global equity market capitalization. So that's factual. The question that we need to push ourselves on is it sustainable and how much further can it go?
Do you think that bonds are overly optimistic or stocks, both? Which is more optimistic?
It's very scary when bonds are overly optimistic. But if you look at credit spreads now, just let's focus on the U.S. if I could for a second. So as you guys know, we manage $200 billion globally. We are a lot in the credit markets, private and public, as well as public equity. And when we look at our credit, when we think about fixed income markets in the U.S., we do think the credit markets are expensive. And we are underweight credit in some of our portfolios. And it is a negatively convex trade. And what I mean by that is that we are taking that underweight position, which means we're carrying under some of our peers and indexes in our kind of core plus portfolio. But that gives us liquidity and optionality to take advantage when there is a dislocation and step in when other people can or won't.
Do you think that there will be a dislocation? Do you expect that there will be some sort of inflationary shock that will cause people to realize that maybe things are too optimistic?
So I don't get to see that many panels here, but yesterday I was in between events and I watched a panel, and I'm not going to name the person, so don't ask me. I'm telling you that up front. But someone made the comment that that we didn't need to worry about the business cycle because the business cycle's over because it's being superseded by all these mega trends. And it made the hairs like the back of my neck stick up like, oh my gosh. So my answer to you is, of course, something's going to happen. Like, that's how the world works. And our job is to navigate that for clients, to maintain liquidity, again, so we can step up and provide it when other people can or won't, and to take advantage of the volatility. But for active management, actually, a volatile environment can be okay. And I feel really confident about our ability to navigate that for clients.
Well, you were on a panel earlier this morning with me, and you mentioned the deficit. You talked about that being possibly a big risk and the potential, and you can give us the likelihood of a failed auction. Understanding that moment. What does that moment look like, that day of reckoning where we understand maybe we've pushed this a little bit too far?
Well, just taking a step back, when you ask the question, like, what could go wrong here, we are running a large current account deficit, defined as peacetime periods, effectively, 6-7% as a percentage of GDP. That's called an economic miracle in the United States. It's a fiscal crisis in France, where they were doing the same thing. Why can we do that? Because we have the exorbitant privilege of being the world's reserve currency. My comment to you is that this could go on for a long time. Like, we don't know what the catalyst is that's going to make people focus on that. But I would absolutely put it on the list of things that could go wrong. And we need to get it under control. And there's been a commitment from our future, I think, Treasury Secretary, that we would try and bring that down to 3%. I just don't know what the solution is for that yet, because the only way you can really get there, it's not going to be Doge, although I wish them the best of luck to run the government more efficiently. But it's going to have to be something around entitlements, and I'm not sure that we have the political will to tackle that now. But to answer, that could be the thing. It might be something else.
Katie, I said it earlier. You're the best. Appreciate your time.
Oh, thank you so much for having me.
And our thoughts are with you and your family too, and the whole community.
I appreciate it. Stay strong, LA.
Much.
Thank you.
Katie Koch, the TCW CEO. Equities down about 0.1% on the S&P 500 with 2 hours until the opening bell. I just had a wonderful conversation with Katie Koch at TCW, just on the risks out there, that yes, things are good, sure they could get better, but in a lot of places that's fully valued. And the number one issue for her potentially is what happens with the fiscal deficit. And Lisa, I know that is your favourite topic.
Well, absolutely, because we have to focus on the auctions every time they come out. And there was a 20-year auction yesterday. It went okay. But there is this concern. And you're not seeing it really expressed in bond markets, which have actually gotten calmer as we've seen President Trump in his third day in office. Will that change? And that really remains to be seen.
We will hear from the president a little bit later on this afternoon, so look out for that. We're 2 hours until the cash open. Let's get you some morning movers. We can do that with Manus Cranny. Hey, Manus.
Jonathan, good morning. This is a company led by Larry Culp. It's their first year, as he said, of standalone, and it was a monumental close to the year for them at GE. They're going to raise the dividend and the buyback. The dividend up by 30%, the buyback $7 billion, and the free cash flow SCF is critically important, just under $7 billion, way ahead of the estimates. So this is about standalone. They divested the power, they divested the health assets. This is a pure play on aerospace. Yeah, they've got supply chain issues, but they're working through those. What a different story for American Airlines. Down 8%. Just think 24 hours ago we were talking about United, premium cabin, transatlantic route. Here you've got an unexpected loss to come in this first quarter. Yeah, they've got record free cash flow, but this is about breaking away from their bullish rivals. They've got capacity constraints. That's reducing their capex. Okay, so your capex is down, but you've got capacity constraint, which really holds you back in terms of what you can actually deliver. Down over 8% at the moment. An unexpected quarterly loss of between 20 to 40 cents in the first quarter. That's on an adjusted basis. Rounded out, entertainment software. I'm not a big player of these games, but there are monumental appetite for this. Apex, Sims, UFC, football games, etc. The guidance here is on their net bookings. It's lower than the market had expected. $7 to $7.8 billion. Just think of some of the names. Global football ending down mid-single digit. This is about peak game interaction, peak numbers in that, and Dragon Age, 1.5 million players. That's down 50%. So the question you're asking is, what does the peak look like in some of the proposition they've got out there in the market? Jonathan, Lisa, good morning.
Manus Cranny, good morning to you, sir. We'll catch up with you in about 60 minutes. Manus mentioned sports. Do you notice that?
Yeah, the sport.
Good. Steve Pagliuca sat down with us, and Lisa leans in and goes, apart from sport.
Okay, all right, okay. Oh, hold on a second. You've been talking about Atalanta for like about 3 years now, and you're so excited. And I know that the whole thing is going to be about Atalanta and Celtics. And honestly, and I think that that's wonderful. But he's got a lot of tentacles in a lot of places. Really, you're going to do this on there?
Bain Capital Private Equity Senior Advisor joins us now.
Let's rewind.
Steve, hello. Good to see you.
Great to be here.
Let's start with sports. Well, you went to the game on Tuesday night.
I thought it was an ESPN.
We went to the game on Tuesday night because Atalanta 5-0. What a story for that team this year.
I'm still pinching myself. It's just incredible. I'm very happy for the team and the coach and the Procassi family. It's been great for Bergamo and Milan, and it's just really exciting.
I don't want you to get too excited, but can you win the league this year?
The old adage, take it one game at a time. So we just got to we got to get healthy. We got a couple guys that are hurt, but they're playing fantastic.
It's amazing to see. Barcelona up next. And maybe straight qualification to not the next round, but the one after that, right?
Yeah,
That's how it works.
That would be big.
Big for European football.
I'm hoping to go to Barcelona.
That's the football, okay? Can I do the basketball?
Yeah, you should do basketball. Okay. Actually, there's a lot to talk about.
I can do the basketball.
Yeah, let's do basketball.
So, reports that you're after majority ownership of the Boston Celtics. How much can you tell us this morning?
I can't comment, as you know, on any deals, including that deal.
Okay, that one specifically. Can we talk more broadly about the NBA franchises and what's happening there? Because I have noticed that audience levels, TV audience levels, have fallen off in some parts. What do you think is behind that?
I think it's fragmentation of viewing, and I think the viewership's really good when they can count it correctly and really find out who's watching where. So I don't think there's a concern there, and the league is really strong and has more stars than ever, and it's been fantastic. So I think that's kind of a bump in the road.
So we've covered football, we've covered basketball. Any other sports that you're going to buy a team in?
No, I'm not into cricket, so I'm good.
Well, I mean, there's golf.
You can do business now, okay? You can move on.
No, I mean, honestly, there's actually a lot to talk about and whether you're going to buy another team. Are you going to buy another team?
Who knows?
Okay, all right. Well, let's move on, because right now we talk about Davos, and it all has been dominated by incredible optimism. America is going to boom, and Donald Trump, what's he going to do? Of course, there's also the overlay of artificial intelligence. What's been your biggest takeaway about what people are concerned about with the Trump administration?
Well, I think, first of all, this Davos is all Trump, all AI. I mean, that's all people are talking about. And the Trump issue is, what's going to happen with tariffs. Europe's worried about tariffs. Everybody's worried about tariffs. What's going to happen with the Ukraine? What's going to happen with the American economy and protectionism? That's their worry. And on AI, AI is for real. It feels a little bit like you remember 1999 internet boom. So there's a lot of hype, but there's a lot of reality in AI, and AI is going to change everything. I view AI as almost like building the railroads and the interstate highway system in the U.S. We're going to need to have that over the next 20 years, or we're going to fall behind. So I think it's a legitimate discussion on AI, and they came out with the Stargate program, which I think is fantastic, because other countries are getting ahead. China's investing billions, UAE is investing billions, Saudi's investing billions. I think the U.S. has to get out ahead of that trend, and it's going to affect everything over the next 20 years. I'm really excited about it.
As an investor, what's your approach to all of this? How do you think about the opportunities? You mentioned the late 90s. Took a while to find out who the ultimate winners would be. Are you expecting something similar this time around?
It's going to be a little different because I look at AI. You had winners like Google that were kind of natural monopolies. There can be many variants of large language models. So there can be a global large language model. There can be probably 4 or 5 of those. But now the real use is going to be vertical ones. So tailoring models with the data, specific data for, say, healthcare. Specific models for transportation with transportation data in it. So I think vertical AI models will be the ones that start to impact the economy. And then the other ones are going to grow, and we need that infrastructure. And then what's going to happen is from that, you need power. Fusion is being talked about and is around the corner. All the fusion companies I look at are getting close to actually generating energy. The models are showing soon they're going to generate energy and build these large tokamaks. That's going to have to power all the centers to get us the GPUs. Because if you look at the power uses of AI, it could be the entire power right now in the United States. So I think this Stargate program or program like it is needed, and we've got to match those other countries. And that is going to create a virtuous loop of spending, building the infrastructure, and it'll be great for America. It'll revolutionize healthcare as well.
I know that you've been very active in that space in particular, particularly in the speed that it will take to put new prescription drugs on the market using different machine learning techniques. I'm just wondering, is that your main focus right now of investment when it comes to AI, or are there other regions that you think are promising in the application in the near term, not just these long-term goals?
Well, I'm focused on the healthcare because I think that's the number one, but it'll be helpful in energy and finding energy and processing energy. It'll be helpful in transportation. It'll be helpful. It's going to be embedded in every business. And I think like liquid AI, which we're invested in, that doesn't require, it's built, as we talked about last year, they studied a worm's brain at MIT. Like, who would do that? There's 300 neurons in a worm's brain.
I think it sounds fascinating.
How many neurons do you think is in your brain?
301. No, I'm just kidding.
The average person has 86 billion. You guys probably have 87 each, but
appreciate that, Steve. Thank you.
You can come on again.
But they've come out with an AI system that requires 80% less power to load it, and that means you can put it on an edge device, so it'll be on your phone. So you're going to have, your assistant on your phone. This is going to start to be on all the phones. It's going to kind of revolutionize the way our lives are.
One aspect of this Davos that's so interesting is that there's some real tensions that need to be resolved, especially as everyone's talking about artificial intelligence. On the flip side, Donald Trump talking about national security. He's talking about the chips in the U.S. that could potentially transmit data back to China or one of our other adversaries or competitors. And I'm just wondering, as an investor, how you understand what's national security and what isn't.
Well, it's difficult. You got to follow the government, and it changes all the time. I think in general we do need national security, but it has to be focused. It has to have a purpose, and hopefully they'll have rational people that decide, what that is.
Do you worry that some voices will get a bigger say in the future in the private sector?
No, I don't worry, because we have a system that I think will work in the long term, and there's going to be a lot of there always has been fighting of different companies for different things, and so we'll get through it, and hopefully we'll do the right thing. We've got a Congress, we've got the court system. Sure. The United States is very stable, so I do think we need cybersecurity, and we need security in general. Hopefully we can have a détente with China, so we don't have that going on. And I think Trump, wants to cut deals, to move the economy forward, and I think that'll be a good thing.
I'm sure a lot of Europeans have asked you on your opinion on what the next 4 years is going to look like. What have you told the Europeans when you're asked that question?
I think the next 4 years, the Europeans, I've been to many meetings here with health ministers and all sorts of ministers, and what they say is the EU really isn't a full union. They use the same money, but there's not an integrated capital market. There's not integrated anything in terms of starting a business. You need to fill out, 100 pages of forms in Germany and different ones in Portugal. So many of them talk to me and say they need to create a 28th state with a set of rules, a virtual state, with one set of rules to start a business and one set of bankruptcy. Bankruptcy is different in every country. You can't have a great capital market if you're dealing with 27 different bankruptcy codes or 27 different ways of doing things. So I think it's a great idea to start a 28th virtual European state, and businesses can opt to be in that or be in one of the 27. But it's hard to be in both of those at the same time. So the big advantage the U.S. has is it is one market. It has one set of regulations. So we have a leg up, and hopefully we'll make that even better in the next 4 years.
I want to return to where we began, which is sports, and my sport, which is auctions. I'm looking at bond auctions, which I think is like a sport right now.
That's quite a term.
Well, no, hold on a second. No, I'm serious, because I wonder how much you're watching what so many people here are worried about, which is that all of this optimism, all of this, happy talk about getting together and really focusing on growth could get really stymied if you start to see bond yields climb and you start to see the fiscal pressures really come into play. How concerned are you about that?
I'm very concerned. All the data would show when you have an increase in the money supply as big as it's been in the last 5 years and a large deficit, that's going to cause higher interest rates and inflation. Those kind of go hand in hand. So my biggest worry is inflation going to get out of control and keep those interest rates up there? I think house mortgages are costing 7%. We definitely have to increase the supply, and they're looking at programs to do that. But with 7% mortgages, that's not great for growth.
You mentioned 1999, and we all know what happened after 1999. And there is this feeling that there needs to be a washout in some of the startup companies as they deal with technology that continues to evolve. Is that the big concern, that this kind of increase in rates could really catalyze that kind of washout? Is that what you're keeping your eye on?
Increase in rates definitely catalyzes washouts, because when money is free, there are no washouts, right? We had free money for a long period of time. Now, the good news is, for most of my life, too long life, most of my life, interest rates have been, T-bills have been 5%, 5.5%. So it's not anomalous. But yeah, that is the fear. We've already seen a lot of the companies' valuations go down and get wiped out. So I think we're kind of through that. I think there is a lot of hype on AI, and there are probably some fundings at very high levels, but I don't see it like it was in '99, where everything across the board was crazy. I used to walk into a room in San Francisco. They give me a term sheet and they say, we have a company that's going to, internet company is going to reduce the supply chain cost of medical equipment. We're valuing the company at $100 million. It has no revenues. This is the idea. And you have 2 hours to decide, do you want to invest $10 million at $100 million valuation?
I'll pass.
I was fell out of my chair. I mean, this is a real story. I said, thank you very much. And 999 of those went bankrupt, and then we had Google and a few other ones that did well. That's not the situation we're in right now.
Steve, you're a gent. It's good to see you.
Great to see you.
And good luck to all your sports teams.
Forza Atalanta, as we say. Forza Atalanta.
Without a doubt. Steve Pagliuca there of Bain Capital, and Forza Milan too. We've got to squeeze that in as well. Can't be all Atalanta every day.
Well, he does. He's going to be the stink eye.
Should have bought that club.
Well,
anyway.
Just letting you know.
Auction of sports. We're doing viewing parties at 1 p.m. Eastern time every time we get an auction.
I think that would be really fun.
Well, we have a brand new renovated stadium, so they're all coming there. Milan is in a very old stadium.
So you're going to host the viewing parties for bond auctions? Yes. Okay. In the Atalanta
Stadium?
Stadium?
Just threw shade at San Siro. Anyway, let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Away from sports, President Donald Trump downplayed the national security risk posed by TikTok. Trump sat down with Sean Hannity of Fox News for his first TV interview since taking office for a second time.
We have our telephones made in China for the most part. We have so many things made in China, so why don't they mention that,
Let me get to
the
some
interesting
issues.
thing with TikTok, though, is you're dealing with a lot of young people. So
they love it.
Is it that important for China to be spying on young people, on young kids watching crazy videos on things?
On his first day in office, Trump signed an executive order delaying the app's ban by 75 days. This week, Trump floated the idea of U.S. buyers like Elon Musk or Oracle's Larry Ellison with a stake from the U.S. government. Ukraine's President Volodymyr Zelensky says that any effective peacekeeping force in Ukraine will need to include U.S. troops. Speaking with Bloomberg's editor-in-chief John Micklethwaite there, Zelensky said that his European allies don't have enough soldiers to pose a realistic deterrent to Putin. The comments followed Trump's threat to impose financial penalties on Russia if it doesn't end the war soon. The historic winter storm impacting southern states have led the NBA to postpone a game in New Orleans. Wednesday's matchup between the Bucks and the Pelicans was shelved after a foot of snow fell on the city. A makeup date has not been determined given the ongoing conditions, with tonight's scheduled game also in jeopardy. So a little bit more sports to end there for you. That's your brief, John.
Danny has some weather too. We appreciate it. More from Danny in about 30 minutes' time. Snow in Louisiana.
Yeah.
Who saw that coming?
Yeah, seriously. It gives people practice, though, with snowmen and such, which I saw. They did a pretty good job.
They've done a great job.
That was impressive.
Colder there than it is here.
Indeed.
Which is remarkable. Absolutely remarkable. Up next on the programme, competing with Trump's United States.
Everybody is going to be competing for the people that they either govern or lead, and that's exactly what you're going to get in Donald Trump. It's somebody, he hasn't been shy about the fact that he wants America to win.
Counting it down to a really important event a little bit later on this afternoon, the President of the United States addressing this forum right here, the World Economic Forum here in Davos, Switzerland. And a president, which we mentioned yesterday, Lisa, who feels vindicated, feels like he's been proven right. All the warnings he had for the Europeans all those years ago, 8 years ago, turned out to be the correct warnings, Lisa, to make.
He feels vindicated, and he also feels loved, which maybe was different than back in 2017 when he first was accepting his role as president, because a lot of people are saying to him, how can we work with you? We think your policies sound great. We want to be more like you, and expect to hear more of the same, at least in public.
Because things in the United States are decent. They're okay. In Europe, things are challenged. Under surveillance this morning, competing with Trump's United States.
I think it's important. Everybody is going to be competing for the people that they either govern or lead, and that's exactly what you're going to get in Donald Trump. It's somebody, he hasn't been shy about the fact that he wants America to win. There's nothing negative about wanting the best for your country and the people that you lead, and I think that people want to see him do that, and that's why he won re-election in such a big way.
Let's continue that conversation now. Joining us, Joe Taylor, the Ontario Teachers Pension Plan CEO. Joe, good to see you again.
Thanks, Jonathan. Great to be here.
Thanks for being here. Last year, we talked about the difficulty in doing business, say, between Texas and California. Maybe we should start much bigger than that this time. Canada versus the United States. What's behind that tension at the moment?
Well, I think saying we're the 51st state's a bit of an opening salvo to that discussion. You know, I would say from our point of view, you know, we're an international investor. We invest all over the world. We probably approach this one from the perspective of saying, probably feels a bit like the sort of discussions we have with our companies and our partners, right? So you try and kick off with constructive collaboration. If that doesn't work, probably move more towards negotiation. If that doesn't work, well, then you have to be creative.
Does it lead you to rethink some of the exposure you take in either Canada or the United States, the kind of companies you want to be owning, the kind of companies you want to stay away from?
Yeah, interesting question, one we've been thinking about. You know, we have a significant investment in the US. It's been a very profitable market for us for 20-odd years. I guess the rethinking is probably more along the lines of how do you essentially avoid just continuing to put more and more money into the US? There's been lots of initiatives that's drawn capital into the US. The markets have been very hot, as we all know, over the last couple of years. You know, we try to run a diversified international portfolio. So in some ways, it's actually, you know, where in the rest of the world do you see growth and do you see a return on the risk you're going to take?
This is interesting because a lot of people are saying the same thing, and we're seeing that in the performance of markets, which is the reason we're talking about European equities performing so well.
Right.
Is that really your takeaway, that maybe places like Europe or even in Southeast Asia offer a better return proposition in the year ahead, given that the United States already has so much capital, and some people are saying is priced to perfection?
Right. So we invest in both private and public markets. I would say on the public side, you know, you can take a debate about the relative value that exists between European and other markets in the US. I think the one that's really interesting in some ways is the active private market, where we do a lot. So for those that don't know, that would be things like infrastructure, private equity, credit. I'm a great believer in go and hunt where the others don't want to tread. So a lot of the Americans at the moment are actually saying, I only want to be in the US. And they've been saying that very openly in Davos. To me, that's great news. I'll just fill my boots in Europe.
Okay, so Europe is the place to go instead. That's what you're having most
It wouldn't be
optimism.
exclusively Europe, but I think within Europe there are still some great companies. There's still some growth, albeit it's probably, you know, you have to actually pick your company and pick your spot. The thing that Europe's had for a long time is a pretty predictable regime in terms of regulation, and you've also got currency, which is relatively stable to the Canadian dollar, which we like. Beyond that, you've got businesses that are of a size where we can invest in them. We're quite a large plan, so our ticket size to invest is relatively significant. And if you're doing that, you want a professional management team, and there are plenty of those in Europe too.
I'm sure you can't name the companies, but could you describe some of the themes within Europe that you'd like exposure to, the things you're actively focused on?
Yeah. So we still believe in climate change. It's one of the things, another part of the discussion at Davos this week, where it's really moved all about AI and data centers. Climate change is going to continue to be in focus. If you live in LA at the moment, you'd certainly say that was an issue for you. So we're still investing around the climate transition. We've done a lot in electricity transmission, that last mile delivery, new types of power or different types of alternative power. And I think then beyond that, what we're trying to do is to be thoughtful about disruptive technologies where we can actually move into a new area, which isn't just AI. So, hydrogen and so other fuels that are interesting. We're also very active, unusually for a pension plan, at the more venture-style end in terms of looking at new disruptive companies. And some of them aren't in AI again, but a lot of them are sort of morphing to that area. We really like technology that enables other sectors. So we like technology that enables the financial service market, healthcare, those sort of areas. And that covers quite a broad church, but we can get into those businesses because we provide long-term patient capital. And in some ways, we're an alternative to an IPO. We can be there for 10 years and really help the business to scale.
Ontario Teachers Pension Plan has actually been one of the pioneers in really sourcing a lot of private deals yourselves and going in there and having a really big presence. I'm just wondering if you think the pendulum has switched from private equity and venture, it went to private credit, and now do you think it's switching back from private credit, which has gotten very crowded, back to more of the equity style private investments?
You're always going to see a bit of this tactical moving around. We've been investing in all of those sectors for 25 years, and we have an outlook which is 50 years out. So there's always going to be a place in my heart and in our portfolio for things like private equity, infrastructure, and credit. Credit's a little bit cyclical. The spreads tighten up when everybody wants to chase the same sort of deals. And I think with private credit, you've really just got to be careful you're not putting the same product into the same business. So I wouldn't do private credit with an equity strip in the same company. But there are opportunities around that. For us, the trick is to get a balanced portfolio that is diversified. We're quite a mature pension plan. This is our 35th anniversary, so happy with that. And, I have those 340,000 teachers in Ontario, and I need to make sure they're not anxious about their retirement.
Well, happy birthday to the firm. It's good to see you, sir. Thank you very much. Joe Taylor there, the Ontario Teachers Pension Plan CEO, on opportunities outside of the United States. I'm still thinking of what Katie Koch at TCW said to us a little bit earlier. 4% of the population, 1/5 of the global economy, and 2/3 of the market cap. It's pretty stunning stuff, Lisa.
Yeah, and that's the reason why there's so much focus. I do think going forward, this is going to be a question, though. How do you rebuild? How do you get some sort of sense of prevention going forward?
Up next on the programme, we'll get into that. We'll catch up with Morgan Stanley CEO Ted Pick, the EQT CEO Toby Rice, Nela Richardson of ADP. Jobless claims just around the corner. And we'll catch up with the CEO of Infosys.
The U.S. is going to continue to attract capital.
When you think about the U.S. economy, it's in a good place.
There is reason for optimism. There are green shoots that people are able to point to.
The ability to be successful, the rules, all that has really driven strong growth in the United States.
As America goes, so goes the world.
This is Bloomberg Surveillance, live from Davos, with Jonathan Ferro and Lisa Abramowitz.
American executives have totally taken over this forum. At the World Economic Forum in Davos, Switzerland. Good morning to you all. Stateside just waking up. The big event later on this afternoon. The President of the United States, Donald Trump, calling in to this forum. And a lot of questions from American CEOs and European CEOs, Lisa, already lined up.
I love that he's calling in because we were wondering, did he even feel the need to be a part of this event where he's already dominating it about the will he, won't he kind of discussion. Now, there could be some real questions, maybe. And we were talking about that. How much is this going to be a forum for executives to talk about how much they appreciate him and they like what he's doing and please don't hurt us and make our business life much better versus actually trying to clarify some of the vagueness? finance right now.
I was listening to Guy Johnson of Bloomberg a little bit earlier on out of London, and Guy made the point that markets were like this, a clenched fist. Donald Trump's come in, and there's a release. A lot of people just relaxing, just a touch. Should they be? When it comes to trade, that's got to be the focus. A threat of 25% tariffs on Canada, on Mexico, 10% on China. And the message for the Europeans, you might get it too. That's still on the table here, Lisa. Now, whether your operating assumption is that that's just negotiation and we'll end up somewhere else, that still looms large.
What's fascinating, though, about Davos is that the discussion has changed from will tariffs hurt Europe to Europe, let's get our business in order. Let's deregulate to some degree so we can compete better with the United States. It is a different tone, and that is where people are getting more optimistic, actually, about the European continent, certainly when it comes to investing.
We've asked that number one question repeatedly. How little needs to go right in Europe to generate some big gains, because the bar right now is really, really low. I'll go back to those numbers from Katie Koch at TCW a little bit earlier this morning. 4% of the global population, 1/5 of the global economy, 2/3 of the market cap. That right there is US exceptionalism in 3 numbers. That right there is dominance.
Yeah, and Joe Taylor, though, is talking about the capital is there. Now the question is, how do you put more capital on top of that capital and actually have a really good return? It's getting harder, and that also is a conversation that we keep having.
Let's head over to the nation's capital and catch up with Anne-Marie in Washington, D.C. AMH, we're all waiting for it, an address from the President of the United States. What's in store?
That's right. He's headed to Davos this time around, he's going virtually. Not exactly sure what he's going to say to this group of global elites, I think, as he would call it. But based off what he said in the past, I think, Jonathan, you nailed it yesterday when you called it a level of vindication the president is going to have. Because in the past, he lectured this group about being enslaved to Russian energy, about outsourcing their entire defense on the United States and only spending 2% of their GDP. He'll likely call for more defense spending, and also probably will talk to them about tariffs. This line stuck out to me from President Trump in 2020. They have trade barriers where you can't trade. They have tariffs all over the place. They make it impossible. They are frankly more difficult to do business with than China. So I can expect potentially some of that tone with the group of Europeans. What's going to be interesting is the Q&A portion of this. Now, these aren't journalists, and these are likely people that want to curry favor with the 47th president or those that already have. I'm thinking of Steve Schwartzman, so that's likely going to be a softball question. But potentially we can hear things like deregulation, what these tariffs and trade may look like, especially from Anna Botin of Santander, or what the energy landscape may look like in the United States from someone like Patrick Pouyanné from Total.
Anne-Marie, looking forward to the coverage a little bit later. Look out for that 11 a.m. Eastern Time. No softball questions here. Joining us, the Morgan Stanley chairman and CEO, Ted Pick. Good to see you.
How are you guys?
Good to catch up with you, sir.
I got a little rattled when we were about to start because you said big event. We're coming up to a big event, and I thought it was our interview. And then you're like, oh.
Should I restart?
Yeah, let's restart.
Well, you're sort of like,
all right, let's restart.
I was like, okay, this is, I'm like filler.
We're going back to T-shirt.
Yeah.
All right, you ready? That wasn't live. This is the real thing.
Okay.
Live from Davos, Switzerland at the World Economic Forum, the big event. Ted Pick, the Morgan Stanley chairman and CEO.
Fantastic.
Good to see you,
guys.
sir. 1 year in the seat.
Yes.
It's flown by, hasn't it?
1 year and 3 weeks.
How's it feel?
Amazing.
Yeah.
You know, you come into this job and you want to do good, but what you discover is the quality, the underlying franchise and the people, and it's a wonderful franchise. They got the keys to a great car, and the partnership is alive and well.
Now you've got to hit the ground running.
Yeah.
American bankers running around CEO, very, very, very happy here in Davos, Switzerland, these CEOs and American bankers. Are you one of them? Are you optimistic about this year ahead? And what is it about the incoming administration that gives you that confidence?
Jonathan, I am positive because it is definitely a change in tone. It just feels like the overall framework is one where there's going to be more interaction between the public and the private sectors. What you guys were talking about the last couple of minutes, it can't be state actors alone, and it can't be private companies alone. So the fact that there's real dialogue building, I think that's a huge plus. And on the European question, sort of interesting comment, too, because I think there may be some catalyst to some now reflection. You know, there were the Draghi papers. Did people read it? They kind of read it, but there was nothing. Capital Markets Union, Banking Union, kind of European sort of self-strength. Maybe this is a catalyst to some real conversation. So in that sense, I think it's positive, too.
Are you hearing about actual business activity stemming from that change in tone in Europe, or is it just sort of a conversation at this point?
Well, I mean, we're like, 25 basis points into the new administration, right? We're just getting going. But yeah, a hell of a lot more than you would have expected 2 or 3 weeks ago. I
thing-
think it's constructive.
One thing in your earnings that really stood out was the stock trading revenues that really boomed. And I'm wondering, this has been a discussion about how risk on things have been feeling, certainly at Davos, but through the last couple of months. Do you see that waning at all, or is it just continuing to amp up in terms of risk taking?
Well, when you become a CEO, one thing is for sure, all of your children are equally beautiful. But our equities business is one of our more beautiful children that I adore. And yes, they put up some great numbers. And I think that is a reflection on just the quality of the underlying franchise, but also a sense that people want to allocate to a little more risk. But importantly, they kind of want to get beyond the index level. You guys talk about this a lot, right? Sort of index level equity risk premium relative to sectors. And I think one of the positives here is we're talking about deregulation in the energy space and energy transition. We're talking about the financial services space. And yes, you need to own the 6 because they are money machines and great companies. But how about the rest of the 493, 494? And I think some of that dispersion getting kind of allocated across names and sectors and around the world, I think that's a multi-year trend. I think we're early on that.
Concentration is certainly a risk factor that a lot of people are considering. Another one is the deficit and the cost of interest payments for the US government. For you, for the capital market business, is that a risk more generally that you and the team are focused on?
Yeah, you've been talking about that a lot, and I'm sort of, and I think it's important because if you don't talk about it, it sort of says, there's no canary in the coal mine, right? But I do think there is the fact that there has been so much attention given to this, and you have folks like Besson coming in who know the bond market, that it has a sort of reaffirmation that we got to look out on that. Simpson Bowles, here we are these years later. That having been said, term premium is still pretty narrow. So, we haven't seen the long bond really move. So there's an underlying confidence. I think the question is, what kind of growth can we generate? I think so the conversation that one would have is which comes first, sort of the potential inflationary effect of tariffs or the positive deregulatory effect. And I think that's going to be one of the things we know is that there's going to be an ongoing dialectic, which policy function can be transmitted more quickly than the other. And I think that pivoting and transitioning and the dialogue is important.
Do you think it holds back activity? That degree of uncertainty, given how confident everyone is, and Lisa especially, me too, we get nervous when everyone in Davos gets really confident.
Yes, the contraindicator.
Does it hold back activity without having the clarity on what these changes are going to look like?
I think part of the dilemma is that the vernacular of whether we're really moving with animal spirits is whether we see a bunch of M&A prints. Like, where are those M&A announcements? And the reality is, over the last number of years, we've had, I think, 2 major uncertainties, right? The end of financial repression, 0 and 0, is that finally passes? And do we kind of know where rates are going to be? And we can focus on the detail of whether there'll be, 1 or 2 moves or none at all. But at least we generally know that for the next period of time, the U.S. risk-free rate is somewhere in the mid-4s. And then you can apply discount rates for country risk and the company and the rest of it. So that's kind of past us. So that's an uncertainty that's taken off the table if you're a CFO and you're in a boardroom. The second set of uncertainties has been around sort of the end of history, which is the resumption of nation states and the like. And one could argue, well, there's a lot of uncertainty in the world. I would argue the combination of having some sense of a rate framework and having some sense that things are going to happen in the U.S., in Europe, around the world, I think it galvanizes the corporate community. And so the question is, how much is the market discounted that? How fast will that be? And I do think important catalyst to this will be there are the better part of 1,900 companies in the private equity space that have $1 billion of aggregate value, 5 years of life on average. Those companies need to move. So at some level, I couldn't tell you exactly the pacing of that activity, but we've been below trend line in the M&A market. We talk a couple years from now, I think we'll be a trend line or higher. I'm pretty confident about that.
You think it's going to be M&A? You think it's going to be IPOs?
I think it'll be everything. I think we've been talking about, you've talked about so much the sort of paucity of investable names, especially when you get past the big 7 companies and they're sort of small cap orphans without research. I think there's yes, it can be painful, Starbucks, for a young company to be public, but you get enduring long-term value from shareholders that actually can also add some value, and you can use that currency to make other acquisitions. I think the IPO product is alive and well, and I think importantly, what's happened as a sort of financialization of the markets is the intersection of private and public. That's come of age. So maybe you don't go public in the classic NASDAQ, New York, IPO at the first, maybe you do some hybrid capital for a while, and then you go public a la Uber with a full capital structure.
One area that you've brought in, one of your babies that's very beautiful that I'm sure you talk about, is your wealth management unit. And
yes,
I'm curious
that's
about...
a big baby.
It's a big baby.
Big beautiful baby.
It was one of the drivers of revenues for a very long time. What's been the challenge in accumulating assets in the wealth management, growing assets to the degree that you really have wanted to?
Well, you have a massive denominator, right? And I think what's happened is we're now the better part of $8 trillion of AUM between wealth and investment management. If you look at sort of point to point, what have assets done? And obviously higher markets held. The assets in 1 year went up by $1.3 trillion. So people say, okay, you raised 250. Well, that's a huge number. And for me, Lisa, what's really important is how is our funnel working? Like, think about our wealth business as sort of having three parts. Self-directed E-Trade, we're seeing transaction activity really kicking up. That's clearly a positive signal, part of what you were asking about in the sort of pure equity space. We have this workplace business. I want your stock plan business because then I can do factory floor to CEO. And then the fee-based advisor, 50 basis points per annum. And the fee-based advisory growth is quite impressive, and is going to continue for years to come, especially if clients need to allocate across sectors.
You've made a lot of acquisitions in the past. Any in the pipeline, planning any further types of tie-ups yourself?
You know, it's interesting. We see stuff, but I really love the durable growth organically that we have in the two major businesses, the investment bank and the wealth and investment manager. But over time, we'll continue to look at stuff as we accrete capital. Sure.
We've got 1 minute left.
Yes,
I want to
sir.
squeeze this in. Have you spoken to the president?
I have not.
Not recently?
Right.
If you had the opportunity to, and Davos will today, to throw a question at the incoming president, the current president, Donald Trump, what would you ask him?
I like the quality of the questioners you have. I do. I like the quality of the questions you have.
If your name was in the mix and you had one, what would that question be?
He tried to punt by saying he's not going to do it.
I think the question I would ask is one where it would give him the opportunity to sort of speak to the possibility that he's thinking about a lot of different possibilities on a lot of different issues. Something along the lines of, are you open to taking idea flow around a whole bunch of different spaces and give examples? And I think my guess is the answer that he would give is yes, and I'll give you examples of that. And the reason that's important is because I think we're so early in this administration. People are trying to sort of weigh how much is tactical versus how much is baked. I think there's a lot of discussion, and people, it wouldn't be so much for him, but people understanding that there's a real conversation taking place on a whole bunch of important issues, and we're only 5 days in. I think people hearing that will give confidence that we are in the early stages of the dialectic, and there's more to come.
Ted, appreciate your time. This was a great
Thank you so much for having me, guys.
Thank you, sir. Safe travels back to New York.
I'm an avid listener and watcher.
Well, we appreciate that.
You've got to come on again soon.
Ted Pick, the chairman and CEO of Morgan Stanley. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Fire crews are battling a new fire north of L.A. The Hughes fire broke out yesterday and quickly spread to 10,000 acres. About 50,000 people are under evacuation orders and warnings in the region. The fire is currently 14% contained. More details emerging involving President Trump's plan to make the U.S. an AI powerhouse. The information reporting that SoftBank and OpenAI each plan to commit $19 billion to the $100 billion project known as Stargate. The tech outlet says that the two companies would both own 40% of the endeavor. Tech industry players like Elon Musk have been questioning the lack of details around the venture and its financing. And the New York Jets have found their next head coach. Former Detroit Lions defensive coordinator Aaron Glenn has agreed to become the franchise's next coach after interviewing with 5 other teams. Glenn joined the Lions in 2021 and becomes Detroit's first coordinator to be hired by another team since 1963. He was drafted by the Jets as a defensive back in 1994 and played 8 seasons with the team. That's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, priced for perfection.
The dominant mood is extreme optimism. The question that we need to push ourselves on is it sustainable and how much further can it go?
The opening bell, 1 hour and 12 minutes away. Going into that opening bell, equity futures down by about 0.1% on the S&P 500. Big conversation at the World Economic Forum with market participants. Yes, things are good. Sure, this economy could get better, but are we priced for perfection?
The dominant mood is extreme optimism. A lot of that optimism is priced into the markets. And this idea of U.S. exceptionalism, just to put that into context for people, just factually, the U.S. has demonstrated exceptionalism. We're 4% of the world's population. We're 20% of GDP. We're 68% of global equity market capitalization. So that's factual. The question that we need to push ourselves on is it sustainable and how much further can it go?
Lisa, that dominance is incredible. We've mentioned those numbers a few times. 4% of the global population, 1/5 of the global economy, and 2/3 of the market cap. Dominance.
And that's the reason why everybody is talking about focusing on the United States. And the key here is just trying to get past that to understand what they're actually doing with their money.
Counting it down to the opening bell. Let's get you some morning calls. Let's cross over to Manus Cranny. Hey, Manus.
Jonathan, first up, we're going to kick off with Goldman Sachs. They're lowering the price target on Apple to $280. They actually say dominance here may be shifting, citing lower iPhone sales. And you got it, competition from China. What carve-out might they get on the tariff story? Next up, Bank of America raising the price target on Meta to $7.10, highlighting optimism on the company's AI capabilities. This is sprinkles on top. And finally, research upgrade for Netflix to outperform, pointing to strong fourth quarter results and easing growth concerns. Just remember those belter of numbers that we brought you yesterday. 19 million subscribers in Q4. John.
Manus, thank you. There is going to be a huge investment in AI and associated data centers in the United States of America and worldwide. Lisa, we've already seen that. That is about to get even bigger. That means there's going to be some serious energy demand. So let's talk about that with the EQT CEO, Toby Rice. Toby, good to see you, sir.
Hey, guys.
Gas is in demand big time. Let's start with you on M&A. I want to start with mergers in the incoming administration, the new administration. Got to get used to saying that. It's been difficult to make deals under the Biden administration. Is your life about to get a little bit easier?
I think our lives are going to get a lot easier, not just from M&A. I mean, I think you look at this energy market that we have right now when people are scratching their heads. I mean, we are producing record amounts of energy in this country. If you added up the oil and gas that's being produced in America, we're producing over 30 million barrels a day equivalent. Now, you would think that that would translate to lower energy prices, but energy prices for Americans are up over 35%. Now, if you're scratching your head, you're like me, and the reason for these bizarre facts that are happening is because political force has overwhelmed market forces when it comes to energy in America. It's never been more difficult, and the past administration has made it incredibly difficult to get energy projects built, whether that's pausing LNG or requiring an act of Congress to get a pipeline built. Having Donald Trump come into office is a very welcome change, and we hope that we will let market forces take a backseat and let market forces drive the cheapest, most reliable, cleanest energy to the marketplace.
I'm looking right now at natural gas futures. They have ticked up. They are just below $4 a barrel. They were as high for $4 per unit, which I'm not familiar with, which you can tell me. But the highest was going back to 2022. I'm crushing it here because I know so much about it, of almost $10. Why has it declined so much? I mean, basically, is it difficult to get investment at a time where you're not seeing the requisite increase in prices?
So natural gas prices have been incredibly volatile. Just think about it. Right now, we're looking at a natural gas average price of about $4 per million BTU.
Thank you.
In 2024, that was about $2.25. That's a big swing. Now, for perspective, people need to be reminded, $4 natural gas is the energy equivalent of $24 oil. So this is still the most cost-effective energy solution that's out there. What's going to be driving natural gas prices? Simply put, there's going to be a lot of volatility. We've seen natural gas demand increase 50% over the last 15 years. The pipelines to service that demand have only grown 25%. And most importantly, the storage infrastructure to buffer the price and supply and demand has only grown 12%. And so that means that price is going to be the buffer, and that means volatility. And we'll see periods of time where prices are $2. We'll see periods of time, like we saw in 2022, where prices were north of $6. You've got to be a low-cost operator like EQT to weather the storms and give your investors exposure to what we think is really compelling upside.
So the key to being resilient is both being a low-cost, being big enough, and having the access to building what you need in an expedient manner. Which do you see happening for yourself? Do you plan on being part of any acquisitions on either side, or trying to build in some kind of way, given that permitting is probably going to get a whole lot easier?
Yeah, our strategy is very simple. Starts with our North Star becoming a low-cost operator. With the Equitrans transaction that we just completed, we have completed our transformation of EQT. Over the last 5 years, we have built an incredibly high-quality company. We've increased our productivity and scale by over 50%. We've almost doubled our inventory to have decades long of inventory. We've lowered our cost structure by 30%, and we've doubled our free cash flow per share capabilities. So this is a very strong, healthy business, and it's incredibly important for us to be able to be strong so that we can meet the needs, because the demand for natural gas is incredible, whether you're talking about providing energy security to our allies, lowering American energy bills, powering the data center build out to fuel this AI revolution, or simply making the environment, lowering global emissions by replacing coal. 20 to 40 BCF a day, which would be a 20 to 40% increase in natural gas demand, is coming over the next few years. And as America's natural gas champion, EQT is ready to meet that demand.
Toby, we'll hear from the president a little bit later at the forum. He's calling in from Washington, D.C. I mentioned this to Ted Pick of Morgan Stanley earlier on, about 10 minutes ago, actually. I asked him, what would you ask the president? What is it that you want to know from the president of the United States?
It's very clear that what needs to happen with energy is we need to get back to letting market forces drive the energy that makes its way to the marketplace. Making sure that permit reform is key to making sure that happens. I think permit reform is inevitable because we are in such a fragile state with our grid and our energy system. We're either going to be reactively fixing permit reform, like what Germany did in 22, where they got energy projects approved in 5 days when it used to take them 5 years, or we can be proactive and get ahead of this. So permit reform is going to happen. I think the most important question to ask is, it's one thing to let market forces work, but what can we do to incentivize these market forces to drive, not just the clean aspects of energy? What can we do to incentivize the reliability of our energy system, which has been significantly attacked over the past few years? We are in a hole when it comes to that, and we need to get back to incentivizing reliable energy systems.
Toby, appreciate your time. It's kind of you to drop by. Thank you, sir.
All right, thanks, guys.
Toby Rice there, the EQT CEO. Lisa, a lot to get through there, but ultimately a shift, a new era potentially for the energy industry.
Per BTU. Per BTU.
Anyway.
Just kidding.
Should we go?
Yeah, let's get out of here.
All right. Coming up next, Nela Richardson of ADP and a jobless claims report. We'll bring you some economic data in just a moment. We'll catch up with Mike McKee, live from Davos, Switzerland. You're watching Bloomberg TV. We've been fairly light on economic data. We'll get some in just a moment. Jobless claims just around the corner. Light on Fed speak too, which is a good thing sometimes. It's the blackout period. We'll hear from the Federal Reserve next week. That Fed decision is a little less than a week away. Equity futures right now on the S&P down 0.1%. We are negative on the Nasdaq by 0.5. Sneak peek of the bond market going into this economic data before we get over to Mike McKee. A 2-year, 10-year and 30-year. A little bit of a lift of the long end yields higher by a basis point or two. Let's get across to Mike McKee for that data. Good morning, Mike.
Good morning, John. Well, we're basically seeing a small rise in jobless claims, 223,000, which is up from the originally reported 217,000 the prior week. We'll see if that is revised. 1,899,000 continuing claims, and that's an increase from a revised 1,853. Let me just check here, and we'll see if there's a seasonal impact in here. Unadjusted claims, 284,000 is down 68,000. The seasonal factors had expected a decline of 75,000. So this is probably just a seasonal jump from the seasonal factors, not a real change in the outlook for unemployment claims at this point. We're just coming out of the season in which we see problems in the markets or in the claims because of holidays. And one last note here, California. Jobless claims last week only up by 6,700. They were up 13,000 the week before, so we're not seeing a major jump in claims yet from California because of the fires.
Mamaki, appreciate it, sir. I think that's going to be a big question for a lot of us as we anticipate incoming information. Just how much disruption will we get in the economic data? Katie Koch at TCW, of course, affected by those fires directly. She talked about that earlier to us. But the Los Angeles region, that's a bigger economy than where we're sitting in the whole of Switzerland. Elisa, that's going to be a big issue for the incoming economic data. And I will say this, a small upside surprise on jobless claims. If you take a look at the bond market, 2-year, 10-year, 30-year, as Mike McKee was speaking, Lisa was aggressively typing up on the laptop on the Bloomberg terminal looking for the intraday move of a 10-year and 30-year bond yield. And Lisa, just slipping back just a touch, not a big move, but slipping back just a touch.
Slipping back a touch as people take a look at the idea that not only did you see a small upside surprise in ongoing initial jobless claims, but the continuing claims you saw actually tick up to almost 1.9 million. So this also signaling the sense that, you know, around the margins, maybe things aren't as robust. I will say the most interesting market move was dollar-yen. And you saw the dollar weaken versus the yen more significantly ahead of that Bank of Japan rate decision. Again, good evening, Tokyo. A very large focus on some of these potential moves.
Joining us here in Davos, Switzerland, Nela Richardson, the Chief Economist and ESG Officer over at ADP. Nela, good to see you as always.
It's great to see you, even in coats, even outside. But boy,
it's quite a view,
that view.
You can't complain about that. It doesn't matter how cold it is. And we've said this repeatedly, it's colder back home than it is here. So mate, we've got away from the cold weather. Nela, everyone's run around Happy Valley, very happy with themselves about the US economy. How do you read things? Jobless claims up just a little bit, but still historically very, very low. What's your read on things?
Things are very stable right now, but I don't think that stability will stay. I think that there is a lot of stasis in the labor market. You can see it. You can see it with these very low jobless claims numbers that just came out. We're at 2-year lows. We're lower than we were going into the pandemic. But I do think you see the threads starting to fray when you look at initial jobless claims. It's taking longer to get a job. We're seeing the wage growth, pay growth come down a bit more. And so there's a little less heat in the labor market fire. I hope it's not a cool down, but it's too early to tell.
It feels like these things have been going on, though, for quite a while. And we've had a few head fakes along the way, particularly in the summer around the labour market. It seemed to spook the Federal Reserve. Since then, things have changed. What is it that you see that says that things are going to break one way or the other pretty soon?
So I look at the dichotomy in the labor market. I look at the difference from cyclical to non-cyclical industries like healthcare, which has been the driver of growth in the labor market, versus manufacturing, which has been on its heels for a very long time. I look at the dichotomy between large firms, which are really motivating all the gains in the labor market, versus small firms that are struggling. So that's where you're seeing the pockets of weakness. And those pockets of weakness could be, as manufacturing surveys have been in the past, a leading indicator to the entire U.S. economy. When manufacturing typically slows, the but the U.S. economy is quickly to follow. I keep saying global because we're here in Davos, but I keep saying global because the U.S. is driving global growth right now. So if the U.S. slows, so does global growth.
Which is the reason why people are taking a look at some of these numbers and saying, how much can we actually read into it? And John was talking about Los Angeles and some of the distortions there. And I just wonder, is this basically the new reality that every data print doesn't give us that much? Are you seeing something that gives you a sense of just how much momentum there could be or couldn't be behind it, where you can look through those distortions more easily?
I don't think it's time to look through those distortions. That's why I'm glad I work for ADP. I'm going to give a plug for fine-grained data. The fact that you can go into a locality, look at the workers, see the disruption and its effect on hiring. It's going to be super important. So I'm going to be looking at Los Angeles County, a big job center, in terms of displacement. What industries benefit from the massive and really sad displacement we've seen in that county? Leisure and hospitality. We've seen a slowdown in leisure and hospitality hiring. I see that picking up in LA County because so many people fled to hotels and restaurants. I'm looking at forestry. Eventually, I'm going to be looking at construction. We need that fine-grained data because we need to understand the disruptions and how they affect the overall market.
This is a near-term disruption. There's a bigger-term disruption, a longer-term that we've been talking about here at Davos extensively, and that's artificial intelligence. And I know that your firm and you have been doing a lot of work on what the implications are for the labor force. Are humans going to be needed in about 10 years?
I hope so. Now, you didn't ask me if economists will be needed in 10 years, luckily, but humans for sure. You know, we partnered at ADP with the World Economic Forum on the Future of Jobs report, but it's really about not the job, it's the task underlying the job and getting the worker ready for continuous change in how their tasks evolve. And I think this point is missed when we talk about generative AI. We're still talking about jobs. Jobs are quickly becoming old-fashioned. It's really about how those skills move the worker through the transition of technology. Unfortunately, workers feel unprepared. We did a global survey at ADP, the People at Work survey, 38,000 workers, 34 countries, and we found that 24% of those workers don't feel like they have the skills they need to advance their careers in the next 3 years, let alone the next 10.
So what does that mean? That some older generations are just going to basically fall out of the workplace as younger generations learn how to adapt faster? Or is there some other broader implication?
You know, that's such an interesting question because you match what we're hearing about generative AI and technology and advancement with what we know is going on with demographics and aging. We're not talking about the number of skills walking out of the door of the U.S. labor market every day as boomers retire. Like, how do we retain that institutional knowledge, that people connection, and match that with technology? We're losing skills every day. So my thought is, how do we retain those skills, lead to more flexible work environments, keep people attached to the labor market longer, maybe in non-traditional ways, so that we can help workers transition through these megatrends that we're seeing?
I worry about graduates. I worry about the younger generation quite a lot with regards to AI. You mentioned them being unprepared. I think they are totally unprepared for a number of reasons, including academia right now, which is, I think, pushing them away from using these tools, which can benefit them. We've heard a lot about that. You're living it. That's point one. I would say point two also, and you've talked about this repeatedly, that they just don't have the skill set, the soft skills, and they haven't been working on them either. And as an additional point I'd make as well, Lisa, and I keep going back to a conversation we had with Brian Moynihan of Bank of America, not this year, but last year. This is my worry. The banks are going around saying that they're going to be able to do more with less. So each and every dollar of revenue they're able to generate, it will become less and less labour intensive. That might not mean layoffs on the whole, but it will certainly mean a lower recruitment and potentially out of college and university. And Nela, I want to understand from your perspective what your advice would be to a graduate, maybe a software graduate who was told, you know what, go and learn to code. 4 or 5 years ago, they've gone and done that, and then all the tech firms are turning around saying, yeah, we might not need that anymore. Yeah. What's your advice to them?
This is the irony. First of all, I'm just going to recognize the pain point that they're going to face in this labor market, because skills have never been so easy to acquire and so hard to retain. Because technology is moving fast. As soon as you learn that coding language, it's already changed. And so my first piece of advice is to really evolve with the technology. It's not enough to just rely on your degree. In fact, our survey says that degree holders feel no more prepared than non-degree holders when it comes to skills. The second thing is those soft skills. They never go out of style. Learn how to use the phone, network, call people, like meet for coffee, engage with people, interact with them, collaborate, evolve, learning from different demographics. You have the benefit of 5 demographics under one work site. Use it to your advantage.
There's another aspect to this transformation that's pretty interesting, which is the skills that are harder to replace with AI are things that are traditionally more blue collar, that are actually people who are, making things, that are building things, that are teaching people, that are caring for people, et cetera. Is there a shift where you're going to start to see some of the office-related jobs shrink and some of these others really build out?
It's funny because at ADP Research, we actually quantified that change. We saw coming out of the pandemic the Gen Z increases in blue jobs and manufacturing and producing stuff because so many of those jobs were lost during the pandemic and they had to be rehired quickly. But if you match where the jobs market is to where the demographics are going, that care economy fuels the economy. So if we don't have nurses and healthcare providers, which is a physical, like in the room kind of job, to help us with this aging transition in the United States and in higher income countries, then we don't have an economy to fall back on in terms of other things we'd like to do. The care economy is the backbone of the entire economy. So there are jobs to be had there.
Nela, I'm pleased to do this in Davos, Switzerland. Thanks for being with us. We'll see you back in New York. Thank you. Safe travels. Nela Richardson there, the Chief Economist and ESG Officer at ADP. Reminds me of one of the best conversations I've had this week on the sidelines of this forum. And Lisa, you and I have talked about it. There's a favourite question of mine that I repeat, and you'll hear this repeatedly, I'm sure, in the year to come as well. The kind of disruption that we'd see from AI, will it do to services what globalisation did to manufacturing? I asked the gentleman about that this week. Turned around and said it would be more profound, but with a difference. It'll be in the reverse. It was to your question, to that very point. It won't be about blue-collar workers. It will be about the highly paid software engineers. That's where you're going to see this great disruption.
And if you look at trends and you look at the data, it's already starting to happen on the margins, which is why if you think about the banks and all of those junior associates, are they going to be needed if you can get an AI system to do it? And then who's going to get the experience and how quickly and how many people? These are the questions that people are increasingly going to be analyzing.
I understand the CEOs want to keep the workforce motivated. I get all of that. They don't want to go around and saying there's going to be huge job losses. But Lisa, there's a part of me that still believes that ultimately that headline at some point is going to cross the Bloomberg terminal where you start to see those big job losses because they've replicated that work in the business using AI.
From my conversations on the sidelines here, that day is not now. It is not 2 years from now. It is not 5 years from now. The problem is people don't have visibility on what it looks like after that. And that is what my takeaway was from here in Davos, that people don't understand fully the capabilities with Anthropic CEO saying that AI has absolutely the potential to surpass human intelligence, et cetera. There's a lot of unknown underpinning a lot of the
skin in the
optimism.
game there, just a little bit, right?
You think?
Just a little bit. Talk in their book, just a little bit. The two biggest themes here, Steve Pagliuca said it earlier, of Bain, the Boston Celtics and Atalanta Football Club. You know him well. Steve said it. Two big themes this week, Trump and AI, and basically nothing else. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. Recapping the latest economic data, initial jobless claims rose last week by 6,000 to 223,000, a relatively low level. The median forecast called for just 3,000 less. However, it is taking longer for out-of-work people to find a job. Continuing claims jumped to 1.9 million. That is the highest figure since November of 2021. President Trump's acting defense secretary is deploying 1,500 more troops to the southern border to comply with Trump's declaration of a national emergency. Robert Salesses said that he had also approved of the use of military aircrafts to assist with deportation flights of more than 5,000 illegal aliens detained by Customs and Border Protection. President Donald Trump is also planning his first trip since returning to the White House. Tomorrow, Trump will head to the Asheville, North Carolina site, which is still recovering from Hurricane Helene. Then he'll head to California to survey the damage from the LA wildfires. Looming over his trip, questions about federal funding for disaster recovery. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Thanks for this morning and thanks for this week. Programming note, look out for this. President Trump speaking to the World Economic Forum at 11 a.m. Eastern Time. Ahead of that, join Bloomberg.com at 9 a.m. as we look ahead to Trump's address and wrap up this week at Davos. You can listen to some of our reporters here in Switzerland discuss Trump's impact just days after his inauguration. Terminal users and subscribers can put questions directly to our team. So if you want to do that, feel free. Up next on the program, a change in tone.
I am positive because it is definitely a change in tone. It just feels like the overall framework is one where there's going to be more interaction between the public and the private sectors. The fact that there's real dialogue building, I think that's a huge plus.
Live from Davos, Switzerland at the World Economic Forum. Understandably, there's been one thing in focus, the Trump administration. Under surveillance this morning, a change in tone.
I am positive because it is definitely a change in tone. It just feels like the overall framework is one where there's going to be more interaction between the public and the private sectors. It can't be state actors alone, and it can't be private companies alone. So the fact that there's real dialogue building, I think that's a huge plus. And on the European question, I think there may be some catalyst to some now reflection.
That was Ted Pick of Morgan Stanley, and I think on repeat from American bankers throughout this week. Lisa, some confidence out there, that's for sure.
Yeah, and at a time when there is still a lot of uncertainty, the idea of just simply stripping away regulations and having a pro-business tone at the top is really feeding some of the ambition that we hear from a lot of business executives here.
There's a lot of optimism. I wonder what this is going to feel like in 12 months, looking back 12 months. I wonder if they turn out to be right.
Yeah, especially because it tends to be a contrarian signal. Right now, people are looking forward and saying, where is the money potentially that isn't going to the U.S. and could it be going to Europe in particular?
41 minutes away from the opening bell stateside with your morning movers is Manus Cranny. Hey, Manus.
Jonathan, good morning. We talked about United, we talked about Delta. Today we're talking about American. Very different story here. They're going to make a loss of 20 to 40 cents this quarter. They forced customers to book direct. That cost them $1.5 billion, and they have learned their lesson. They've also got capacity constraints. Gee, Larry Culp, great story here today, upping the dividend by 30%. Free cash flow, just under $7 billion, and a buyback. That is really what's driving this, $7 billion of a buyback. I'll leave you with a thought on EA Entertainment. This is down 17%. The guidance was light. Net bookings guidance cut to $7 and $7.125 billion. They're just lightening up on some of their viewership. Jonathan.
Manus Cranny, thank you, sir. We can head over now to Linda Ramin, who's standing by with a special guest. Hey, Haz.
Hey, John, and you said it. It is about Trump and what impact he would have on not just businesses, but economies. Well, with me is Salil, CEO of Infosys. This is one of India's largest IT companies. Its biggest market is the U.S. Salil, good to have you with us. Lots of questions about how the Trump administration will impact the outsourcing business. What's your take?
So there, I think what we see, first, thanks, Linda, for having me and Infosys here. What we see is many of the policies being put in place, the discussions this week with U.S. executives is all about business becoming more robust in the U.S. So once, if that happens, when that happens, as business becomes more robust with the new approach, we will start to see more economic growth. And typically what we see in those cycles is much more focus on using technology for large programs. So we think it's a positive sign to have that sort of an approach going in. Already we announced our results last week. Last quarter, we had 6% growth. We increased our guidance. Our operating margin was above where the guidance was, above the midpoint of the guidance. So we feel quite good about what this year looks like. And if all of this starts to happen in the U.S., then that looks positive for the future.
Just how good do you feel? Because it was a lackluster year for IT services last year. How is it looking? What are you hearing in particular from your clients in the U.S.?
So the U.S. clients here have been quite optimistic, and their view is with more focus on the economy and with all of those policies coming in place, they are looking forward to more GDP growth in the next coming quarters. And with that, there are new technologies. Of course, there's focus on AI, but there's new technologies in cloud and data and analytics, in digital services.
So spending more.
And spending more in those areas.
Can you actually quantify the kind of spending that you're expected to see in the coming 12, 24 months?
So there, I don't have a number, but what it felt like this week in all the discussions, especially in the U.S. Clients, was much more optimism about the U.S. economy. So we are hoping that translates into our business.
Salil is also about the H-1B visa. Lots of conversations, debates about whether it should be expanded, pulled back. What's your take on the debate right now?
So there, what we've done is made our business more resilient from a few years ago. So three elements to it. First, a lot more work is being done in India for Infosys from what it was some years ago. We've also built some nearshore capability, for example, in Canada and Mexico. And then our employee base in the U.S. is much more local hires, so not dependent on visas, over 60%. So with those activities, I think our business is more resilient. So we feel sort of, let's say, in good shape, whatever direction we take.
So you're fine with whatever they decide to do. We know from our own story that outsourcing companies have been gaming the H-1B and, we're applying far more than what is needed. What do you make of that tactic?
So there, for Infosys specifically, our approach has been to make sure that we participate to the extent that we need it for our client work. In addition to that, we have large digital centers in the U.S., and a lot of the work is done by U.S. employees. So we have no sort of specific view on what other people in the industry are doing.
All right, Salil, we have to leave it there. Salil Parek, there you have it. Salil Parek, CEO of Infosys. John, Lisa, handing it back to you.
Hey, Haz, thank you. Thank you very much. That just about wraps up our coverage in Davos, Switzerland at the World Economic Forum. And I can tell you a very different World Economic Forum. Been coming here for the best part of a decade plus. And Lisa, this time, the optimism around a single nation has been absolutely palpable. When we heard from Donald Trump, the President of the United States, and he talked about a golden age for the United States of America, that resonates with American executives in a big way. They've got a spring in their step. The Europeans, not so much. I have to say, the Chinese, the Asian representatives more broadly for the continent, quite absent at this event in a way that, at least in years gone by, they haven't been.
Yeah, they were absent, and Donald Trump was absent until he zooms in later today. I do think it's going to be interesting to see how much there was a vibe shift. And the vibe shift had to do with taking away regulations and being more pro-business than a lot of these nations and companies have been in a very long time. There was much less of that messaging toward whether it was DEI or ESG, et cetera, and it was really down to how do you grow your business. What I found most interesting was the optimism around Europe getting its act together because so much pessimism had been baked in. That was a continual theme through a lot of our conversations. And the big fly in the ointment, underpinning some of the optimism and maybe challenging it just on the margins, inflation worries and the idea that debt and deficits could go back and rear their heads, the sort of looming cloud of the bond vigilantes.
That is always the looming cloud for you. At the core of everything, core competency and growth. Tremendous growth in America and the lack thereof in Europe and the divergence between the two. Now, there's tons of confidence amongst American executives. And I said a little bit earlier, we'll see where we are in 12 months' time, looking back 12 months. For all of you, for our audience worldwide, thank you very much for being with us through this week. Thank you very much for choosing Bloomberg TV. This, from Davos, Switzerland, was Bloomberg Surveillance.